inflation has been more stubborn than expected.
Inflation is an insidious thing. That said, we continue to think it's a second half of the year when we see the rate cuts happen.
While the market seems content to price in a June rate cut at this moment, maybe the real departure point for normalization is July or later.
We've been saying for quite some time that the Fed will be slower to lower interest rates.
We are seeing the market really fundamentally reassess the outlook for Fed cuts for this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market on the S&P 500 positive by a third of 1%. Last week was all about the data. This week is all about the decision. Top of the pile, the Federal Reserve, Bramo, just around the corner.
Really important, not necessarily because they're going to do anything. They're not, but they are going to release their statement of economic projections. They might start talking about when to end quantitative tightening, sort of the roll-off of the balance sheet. And they might talk about the neutral rate, how they've reassessed their assumption of what the world looks like post-pandemic.
And they've got to somehow go through this data and work out what on earth is going on. We've got sticky inflation competing with soft retail sales. Chairman Powell's looking to gain confidence. Has he gained confidence, lost confidence, or retained the confidence he had at the end of January?
It basically depends on who he's speaking to in Wall Street, because if you speak to one person, they'll say, look underneath the hood, and this is a disinflationary inflation that we're looking at. Good luck trying to figure that out. Other people will say, hold on a second. This is something different. This is a stickier inflation that suggests a new post-pandemic reality that has to be reflected by a Federal Reserve that's talking about a neutral rate still at 2.5% that doesn't make sense.
Now, I know you hate The Bachelor, but indulge me, entertain me. The Wall Street Journal, did you see the piece?
Yes.
On the next Federal Reserve chair?
Yes.
OK, so for those of you that missed this, on Thursday, reportedly, there was a meeting in Mar-a-Lago, Florida, between two advisors to the former President Donald Trump, Steve Moore and Art Laffer, advising, giving their three picks, suggestions to be the next Fed chair: Kevin Warsh, Kevin Hassett, and Art Laffer himself. I have to say, Kevin Warsh himself, not a surprise. If you'd asked me a few weeks ago, top pick, I would have said Kevin Warsh as well. But it looks like they're the three at the moment, and it's not going to be Chairman Powell.
Well, this is sort of logical, even though I think Chairman Powell was nominated and confirmed by Donald Trump. There always is a regime shift. Question is, what is Donald Trump going to push for? Is he going to basically push for an easier policy where they cut rates more? And this goes to really your question, which is, what is take two of a Donald Trump presidency? Does it look like the same kind of rally, or do you see a very different response with potentially cutting rates in an inflationary moment while also trying to potentially increase tariffs?
Let's say it's Kevin Warsh, and I've got no idea if it's going to be Kevin Warsh, but if it is Kevin Warsh, and I've had the privilege of catching up with Kevin in years gone by, it's a pretty hawkish central banker in his time at the Federal Reserve. Hardly someone who was endorsing QE. I'm not sure the market's perception right now of Kevin Warsh would be, let's rally, let's take equities to new all-time highs. He may be a very different person in the seat, if indeed he takes the seat, but at the moment, I think market perception of Kevin Warsh is a central bank hawk.
What's your perception of this episode of The Bachelor? Because do you think that this is Donald Trump picking these people with a sense of what he wants monetary policy to be? Or is this another, hold on a second, if this is a hawkish central banker, we don't want him, right? I mean, at a certain point, you have to wonder what's noise and what's signal. And when I read these, I was thinking, OK, he's trying to basically come out with something that looks and smells like policy, but that will get revised once he sees what that policy actually looks like.
They feel like trial balloons, but I think when one of the advisors is advising that maybe they should be on the list themselves, I'm not sure how seriously to take any of this. That's the latest from the Journal over the weekend. The latest this morning, the stage is set as follows on the equity market on the S&P 500, positive by a third of 1% after a week of losses last week. Really mild stuff, though, down about a tenth of 1% on the S&P. Yields just about unchanged, up every single day last week. The 2-year and the 10-year higher, Lisa, last week by more than 20 basis points, 430.83 this morning.
And this really comes in the heels of the data that you were talking about, stronger than expected inflation. We talk about the weakness, the marginal weakness in the equity market, and that's the reason why maybe one of the most underplayed important events of the week is the NVIDIA GTC conference in San Jose, California. It starts today with a kickoff from the CEO speaking, I believe, at around 4 p.m. Eastern time. Do they give some signal of how much this is going to be adopted in a way that maybe hasn't been priced in? Tuesday, the Bank of Japan decision, monumental moment if they move away from their negative rate policies. This has been the longest holding pattern that you've seen from a central bank ever. It's been 17 years. Just to put it into perspective, the guidance also important. Wednesday is the Fed decision, another really important moment, not because they're going to change anything, but because they might give us some economic projections that clarify whether their thinking has changed. The market certainly has because of the move you were just talking about. And on Thursday, we get the Bank of England, we get jobless claims, and we get earnings. FedEx, as well as Nike. To me, this is going to be pivotal to get a sense of whether consumers really are pushing back or whether they actually aren't, and they actually have the ammunition to keep spending at a pretty robust pace.
And I'm fond of saying this on Monday mornings, but big week ahead. Truly, big week ahead. Big morning ahead. Coming up this hour, Ben Laidler of eToro as investors look to Wednesday's Fed decision. Former intelligence official Norman Rule as Israel's Netanyahu responds to growing criticism from Washington. And Bloomberg's Damien Sassow with better than expected data coming out of China. We begin with our top story. Stocks easing ahead of a busy week of central bank decisions. Ben Laidler of eToro saying this: we are overdue for a breather or pullback after the S&P 500's 24% rally since October, with year-to-date returns annualizing over 40%, a level not seen since 1954. But the rally is fundamentally driven and pullbacks should be bought. I'm pleased to say that we can kick off the trading week with Ben Laidler right now. Ben, can we start here? What is the biggest event of the week? Is it Jensen or Jay? Is it Nvidia or the Federal Reserve?
I think you've got to say it's Nvidia. No disrespect to Jay Powell. I mean, obviously, every central bank on the planet seems that it's saying something this week. It could all end up just being a huge yawn, and we could end up being, back where we started. But, this rally since October has all been about big tech. It's been a one-legged stool. Nvidia's led the charge. So I don't think we can afford a slip up from Nvidia here. I mean, the rally's definitely been broadening out a little bit, but very, very early days. So it's still all on Nvidia.
You say it's fundamentally driven and set to broaden. Nvidia feels fundamentally driven just in terms of the numbers they've been putting up quarter after quarter over the last several quarters. With the broadening out you're looking for, Ben, how fundamentally driven is that rotation?
I think it's pretty fundamental. I think you've just begun to see it. I mean, we've had lower S&P for 2 weeks, but we had equal weight S&P hit first new all-time high in a couple of years last week. We've had Euro Stoxx 50 outperforming the S&P. We've had Nikkei outperforming the S&P. So I think it's happening, and it's happening because earnings either haven't been as bad as expected in the rest of the world, or the outlook is looking a little bit better the closer we get to rate cuts. And I still think those cuts are coming, and those are the two pillars of this. Earnings have been over-delivering, and rate cuts have been pushed back for the right reasons, so to speak, because growth has been a bit better than expected, but they're still coming.
Ben, you said something. We can't afford a trip up by Nvidia. What would a trip up look like at this conference, and what do you mean by we can't afford that?
Well, I can say as much as I like about how this rally is just maybe beginning to sort of broaden out, but so far, it's all been about big tech. Big tech driving earnings 60% in the first quarter. The other S&P 493, flat if you're being if you're being nice about them. So the market is very focused on that growth momentum, continuing until we begin to see growth coming through from everybody else. So expectations are clearly quite high. Earnings expectations high, valuations 30-odd times. We've certainly seen them higher, but no one would say they're cheap.
Which is the reason why, if there is something that gives pause to investors after this particular conference, there's concerns there could be some downside. There's from Peter Scheer of Academy Securities over the weekend, concerned more significantly about a more protracted deterioration, saying essentially that what you're seeing over the past week, I've turned from medium bearish to very bearish. Instead of thinking about a 5% to 10% pullback in stocks, he's thinking about something far worse. I'm concerned much more about a 10% or higher pullback, along with 10-year yields breaking through 4.5%. Ben, why don't you see this as a concern if you do get some sort of more significant sell-off in 10-year yields? Yes, maybe for the good reasons, yet still at a certain point it has to bite, no?
I never say never, but I just think, these twin pillars are still in place, and we have $7 trillion of cash sitting in money market funds on the sidelines. We have our investor sentiment indicators, which are maybe a little bit above average, but it's still a half full glass, not a full glass. I still think that with the fundamentals broadly in place, any sort of pullback is going to be bought by investors. I still think we're right at the early innings of this. If your definition of a bull market is a new all-time high, we hit that 6 weeks ago. Your bull market average is 5 years. I think we're right at the beginning.
Given that you think you're at the beginning, and given the fact that you're considering that perhaps Fed Chair Jay Powell, sorry, no disrespect, is going to be a yawner, is there anything that he could say that would shake a bit of your foundation where we're in the early cycles and maybe reconsider?
I think markets are braced for a sort of modest, hawkish pivot, maybe the dot plot coming down from 3 cuts to 2 cuts. But the market's already come from expecting 7. So I think if that's it, the market's just going to look through it. I think you need to see something, much more dramatic. I think you need to see all the cuts being taken out, 2 cuts being taken out, along with some much more hawkish rhetoric to really unsettle the market here.
Ben, can we build on that a little bit? It's been a subject of conversation now for the last couple of months on this programme, just how this equity market has been able to withstand that repricing of interest rates, which has been quite a phenomenal repricing of rates. You've seen that through the Treasury curve last week as well. We had a move of more than 20 basis points on a 2-year last week, on a 10-year as well. And the S&P 500 was down by about 0.1%. Ben, that's pretty impressive stuff. What's behind that?
Earnings have over-delivered. Quite simply, S&P 500 grew earnings 10% last quarter, big tech up 20, and the expectations, forward expectations are sort of building. Essentially, we're just making our money in a different way. We're making it from earnings, and we're going to make less of it from expectations for Fed cuts and potentially higher multiples. Now, to your point, I don't have my head completely in the sand on this. That can only go so far. So I don't think the market is immune to what the Fed does. I still think this is a fairly sort of long duration market. Bond yields will bite at some point, but I think it has to be very significantly higher than where we are right now.
It's not 430. Ben, what is significantly higher?
I think we need to go through 450.
Yeah. Ben Laidler of eToro. Ben, appreciate it. 430 right now, 20 basis points south of that 450 level. Quite a sell-off last week in the face of hotter than expected CPI and hotter PPI as well. Do you want to call this morning? It's on NVIDIA. It's from HSBC going into this developer conference. NVIDIA buy price target was 880, which is basically where we were. They're looking for 1050 now on NVIDIA over at HSBC.
Have we ever seen a sell moment for NVIDIA after one of their announcements? I mean, it's sort of a Pavlovian response. You buy because they will announce something and it will be monumentally better than anything you expected. That seems to be the playbook that we've had for the past years. So.
Yeah, I said career risk associated with this name. I think coming out and saying sell NVIDIA and then you rip another 50% is slightly problematic if you're an analyst right now on Wall Street.
Which is the reason why I think what actually Ben Laidler said there, that we can't afford a hiccup. If there is some sort of downside surprise, and I know people are going to say there isn't going to be, would you just get over it, that there will be a lot of people who are off sides because it's career risk not to be overweight the stock.
The stock is positive in the pre-market by another 2%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A defiant Vladimir Putin says Russia won't be stopped from pursuing its goals. He swept to record victory in a presidential election that had a predetermined outcome. 71-year-old Putin had no credible opponent and now gets another 6 years as president. BOJ Governor Kazuo Ueda and his board have one more day to decide if it's time for Japan's first interest rate hike in 17 years. A hike at the conclusion of Tuesday's meeting is widely seen as likely after wages at Japan's largest union group announced blowout increases last week. But even with the pay momentum, Ueda has the option of waiting another month. There's a lot of data due just ahead of their April meeting. Apple is in talks to build Google's Gemini artificial intelligence engine into the iPhone. Sources say the two companies are in active negotiations to let Apple license Gemini to power some new features coming to iPhone software this year. For years, Google has paid Apple billions of dollars annually to make its search engine the default option in the Safari web browser on iPhone and other devices. That's your Bloomberg Brief. John.
Hey, Danny, thank you. 3 points there. 1, antitrust. Yep. We'll talk about this later. 2, Apple is clearly behind on this AI effort. And 3, this is going to come to an iPhone near you. Is that going to be the big upgrade cycle that the bulls have been looking for?
How much is this because Apple needs to get ahead of Samsung, given the fact that they needed to do it before the end of this year and they want to get in early? To your point, they're late. And that is what this sort of highlights. They want to partner with Google. What does that look like from a financial point of view?
I wonder also, aren't they always behind Samsung? And then they try and do it better. Hasn't that always been the story with phones?
It has, and yet if this is the case where they're going to partner with someone else, does that mean they don't think that they can do it better? What does that mean in terms of their long-term AI development?
More on that a little bit later. Up next on this program, a widening rift between the US and Israel.
What he said is totally inappropriate. It's inappropriate for to go to a sister democracy and try to replace the elected leadership there. That's something that the Israeli public does on its own, and we're not a banana republic.
That conversation up next, live from New York City this morning. Good morning.
Wednesday, the Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data. We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Big Federal Reserve meeting coming up a little bit later this week. Looking forward to it. The Bank of Japan on deck tomorrow morning as well. AMH is out this week. I'm told she might appear on Friday. It's going to take a few days.
You have to go to somewhere warm, beautiful.
Yeah, if I was TK, and TK would often do this, I would disclose where AMH actually is, but I'm not going to do that this morning.
You're just going to say...
Because it always used to annoy me when he did it to me.
I know. He would do it to you, and then he would say he's on sabbatical and totally irresponsible. We're not doing that. It's actually for work and good for her.
OK, won't be doing that this week. It's actually for work?
I believe so.
It's for work. OK. OK. Equities right now on the S&P 500 positive by 1/3%. 3-day losing streak on the S&P. The longest daily losing streak going back to January, believe it or not. The first 2-week losing streak we've had going back to October. Let's just sit on this for a second. Weekly losses are really rare. We've had 3 of them since the end of October, and we've just come off the back of 2, Lisa. Super rare, given how strong this rally's been.
And they've been minuscule. We're talking about really small, quote-unquote, drawdowns, which makes you wonder, is it a viable dip? Well, this morning, evidently, it is.
Even with a big push higher in 10-year yield, starting the week at around 430. Under surveillance this morning, a widening rift between the US and Israel.
What he said is totally inappropriate. It's inappropriate for to go to a sister democracy and try to replace the elected leadership there. That's something that the Israeli public does on its own, and we're not a banana republic. This is a wake-up call to Senator Schumer. The majority of Israelis support the policies of my government. If Senator Schumer opposes these policies, he's not opposing me. He's opposing the people of Israel.
Here's the latest this morning. Israeli Prime Minister Benjamin Netanyahu rejecting Senate Majority Leader Chuck Schumer's call for a new election, potentially removing Netanyahu from power. Israel vowing to continue with a planned operation in Gaza's southern city of Rafah. Tensions growing between the two nations on a rising number of civilian casualties and a humanitarian crisis on hand. For more, former senior intelligence official and senior advisor to the CSIS Transnational Threats Project, Norman Rule, joins us now for more. Norm, fantastic to catch up with you, sir. I just want to get to this rift between the US and Israel. Do you think this is going to influence decision-making on the ground in any way, shape or form?
Good morning. It's very unlikely this will have any impact on Israeli decision-making. Prime Minister Netanyahu is correct in that the majority of Israelis strongly support a ceasefire to obtain the release of hostages, but also pursuing the war for the defeat to Hamas. So in this regard, this doesn't really change anything that happens on the ground. I would also note that Netanyahu's unpopularity in Washington is not only not a surprise, but it extends back to the Obama administration, and many of the officials in the current administration came from that administration as well. So there's long-standing roots here of disagreement between the two sides.
If the U.S. side is not going to accomplish anything on a fundamental side, why make these announcements? Do they really win political points with their Democratic base?
Well, it's certainly unusual to do this. Usually disagreements between the United States and Israel are conducted quietly through diplomatic channels, and those conversations can be frank and even productive. To make the growing number of statements against Netanyahu, which you've seen Senator Schumer and Senator Pelosi make yesterday as well, I think reflects an effort by Democrats to deal with a progressive criticism of the war in Israel and U.S. support for that war in Israel.
Which is a reason why perhaps you're hearing things that you wouldn't otherwise hear. Meanwhile, you also talk about Qatar and Egypt and how they're placing pressure increasingly on Hamas to try to come to the table with some sort of ceasefire agreement. Can you give us a sense of the nature of that pressure, what that looks like, and how realistic that will be in getting some results?
Well, to begin, there is growing pressure on Qatar itself to use its longstanding relationship with Hamas to obtain the release of hostages and to effect a ceasefire. That has not happened in recent weeks, and there are reports that Qatar has told the Hamas representatives that they might leave Qatar, be forced to leave Qatar, or their bank accounts could be frozen. The deal that Hamas has subsequently put on the table, however, has two parts to it. The first part to it is something I believe Israel would accept: release of hostages for Palestinian prisoners, a 6-week ceasefire, increased aid. The second part, however, is important because Hamas continues to call for the complete withdrawal of Israeli forces from Gaza, which is essentially Israel admitting to defeat in the conflict and the political survival of Hamas.
Norman, as you know, the president, Joe Biden, has set a red line. It's crossing into Rafah. I want to understand the policy options, the viable policy options available to him if Netanyahu decides to cross it. What are they?
Well, I think it's how an Israeli operation in Rafah takes place. So reports are that on March 15th, the prime minister approved such an operation. So I don't think you're going to see a mass infantry tank movement into the city, but you are going to see robust operations targeted, shaped by intelligence to take out high-value targets in Hamas's leadership and to respond to Hamas counterattacks to destroy the two final brigades that Hamas retains in Rafah itself. But it is almost impossible to conceive of how to move 1.5 million people. And that implies that the best thing the Israelis can do is move a small portion of the population and work very carefully. Here's your downside. That implies a longer campaign. That implies longer, perhaps more civilian casualties in some ways, as it's slower for Israel to defeat the Hamas operatives on the ground. So this will be a developing issue, and the U.S. will continue to oppose a mass attack in the city.
You've touched on it there, and I think it's important just to go through it in a little bit more detail, how different this conflict will be at this stage versus previous months if they do cross into Rafah. Norman, how difficult and different would it be?
It's extremely difficult, but it's also not a surprise. This is a small geography. The population has been moved from north to south. There's nowhere else really to move the population. You could send a small portion to the northeast next to the Mediterranean border, perhaps a small portion to the southwest to a cleared area. But unless you're able to get these individuals back into North Gaza, where there is no housing, you really have nowhere else to move them unless Egypt agrees to take tens of thousands of Palestinians, which it has refused to do. So if you're the Israeli military commanders, approaching this operational challenge is very difficult.
Norm, I've got to say, we were expecting this conflict to be maybe further along by now, maybe completed, maybe some sort of ceasefire. Is there still a risk of escalation, or is this basically a contained moment with a lot of pain and a lot of suffering that just continues?
Well, I think for some time I've felt this conflict would go on for weeks or perhaps months. Much depends upon the ability of the Israelis to kill Hamas's senior leadership and to destroy those final military units. So that's a battlefield pace that has some luck, some intelligence issues that goes with that. In terms of containing the conflict, it's certainly true that Lebanon continues to be an area of some risk. Iraq has become more quiet since the United States took out two Kataib Hezbollah leaders. But the Red Sea problem continues to go on, and there's no sign of that ending soon.
Norman, thank you, sir, for catching up this morning. Appreciate your time. Norman Rule there, the former senior U.S. intelligence official. The latest comments from the Israeli leader, Benjamin Netanyahu, over the weekend at the beginning of a cabinet meeting saying this, quote, "We will operate in Rafah. It will take a few weeks, and it will happen." We'll see. Watch this space. That's a red line for the President of the United States, and we're still unsure what happens if Netanyahu crosses it. Up next on this programme, Bloomberg's Damien Sasser on better-than-expected data out of China and a look ahead to a big BOJ decision. Live from New York, this is Bloomberg. Stocks on the S&P 500, equity futures doing okay, positive here by a third of 1%. Bounce back on the Nasdaq, up by 0.7%. There is a why to all of this. Nvidia's up at a pre-market by more than 2%. A developers conference kicking off this week. Already this morning, Ben Laidler of eToro, we asked him what's the bigger issue this week, Jensen or Jay? He said Jensen. Didn't even hesitate. It's all about Nvidia for him.
If they underperform in some capacity, which evidently is sort of an anathema to recent history, there is this question of how much that could potentially cause some sort of drawdown in equity markets. What could he say other than we've got tons of new products, take a look at all the enthusiasm, it will change the world, and boom, stocks go up another 10%.
In 2 weeks of losses, not much of a drawdown, let's put it that way. Even in the face of this, a real repricing of the bond market. Check out the 2-year and the 10-year. The 10-year back in the 430s. 430 after climbing every single day last week, Monday through Friday. We've got a 2-year back through 470, going into the Fed a little bit later. Down a couple of basis points this morning, but essentially starting the week, Lisa, near the highs of the year across the curve.
And it's not just basic nominal rates. It's also real rates. You've seen them kind of rise. And Stuart Kaiser of Citigroup came out with this. Equity markets are falling victim to real yields. This idea that it's being led not just by this idea of where break-evens are, where inflation's going to be, but also an extra premium built in because of the uncertainty for a whole host of reasons. This, to me, is really the key question. Are we crossing the Rubicon with respect to real yields, this point of what investors are going to demand to buy U.S. government debt?
And are we really falling victim, given that last week we're down 0.13%?
It was catastrophic.
On the S&P.
It was really...
In the face of a 20 basis point move on yields, which is pretty impressive.
Well, but hold on a second. If you take a look under the hood, it's actually fascinating. Because if you take a look at real estate, if you take a look at utilities, if you take a look at some of the more interest rate sensitive areas, they actually did really badly. If you take a look at energy, it crushed it, right? We saw a huge gain, best performing asset class. How much is being driven by a goods-related inflation that isn't necessarily positive? It's a very interesting dynamic under the surface.
The commodity market waking up has been a really interesting development of the past week, and we'll turn to that in just a moment. I want to turn to foreign exchange. Dollar yen, just below 150 going to this BOJ decision, 149.13. Line of the morning already goes the kick jukes of SocGen. I love this. I hope the yen understands it's a historic moment. Because, Lisa, we're all talking up the first rate hike since 2007. Dollar yen's hardly moved at 149.
And they've been right not to really respond with any kind of histrionics because this Bank of Japan likes to move like a snail, likes to really kind of telegraph and not surprise too much. Although you've pointed out they have in the past surprised. To me, we talked about this last week, and I thought about it more over the weekend and absolutely think that arguably the bigger surprise tomorrow will be if they don't hike rates. That could potentially send the yen tumbling. And I think that is one risk case that isn't necessarily being baked in.
There's just a feeling that if they do hike interest rates, that might be it. Sort of go once. It's not the start of a cycle. And maybe that's why dollar yen is sort of stuck around 150 still in the face of this.
Subnolent. I wouldn't say it's particularly exciting. It's subnolent, which is shocking considering that it might be the first normalizing move in 17 years. I mean, it's really shocking to think about how stagnant that economy really has been.
They've tried. They've tried very hard. SocGen's kick jukes. I hope the yen understands it's a historic moment. Under surveillance this morning, top story, busy week of global central bank decisions coming from the BOJ, the Fed, the Bank of England, others as well. Traders raising the possibility of a BOJ hike out of negative interest rates tomorrow. The Fed expected to keep rates on hold Wednesday, but investors will be looking to the dot plot and updated summary of economic projections. On Thursday, the BOE also expected to hold as inflation and the job market cools, leaving the door open for cuts in the coming months. It's kind of a wait and see for Bailey and Powell, and it's how they set up that wait and see this week.
And what their longer-term assumptions are. There was a story by Nick Timmeros in the Wall Street Journal that I actually thought was really interesting over the weekend, talking about how it's so rare for a central bank, for the Federal Reserve, not to give some sort of sense of what their framework is for thinking about the world. We don't know what the post-pandemic inflation expectations are from the Federal Reserve. If we get some inkling, which pretty much everyone's going to come on the show and say they're not going to say so, but if they give a sense of that, that could reset people's assumption of what longer risk premia should look like in a new way. And this, I think, is really the key debate. I know it sounds esoteric, but it's actually really...
No, I think it's important. Mohamed Al-Erin, I think, has really provided leadership on this over the last couple of months, the absence of any kind of strategic vision coming from the Federal Reserve. Bottom line, they don't know. But I think for a lot of people, the criticism is they should be providing leadership on it, and they're not.
At the same time, how do you provide leadership from something you just don't know? Do you fake it? Do you come up with something sort of, I mean, they're stuck between a rock and a hard place. I understand that, but it is incredibly unusual. I think it's important to sort of highlight how unusual it is to not have any kind of roadmap whatsoever to be guiding on, and everybody basically darts on a dartboard with a blindfold on, trying to understand what the economy that we're living in really looks like.
Claudia Sam's joining us later. You can ask those questions to Claudia. Claudia's going to have the answers, no doubt about that. Let's turn to this story. The White House showing full support for a bill in Congress which would ban or force the sale of TikTok. National Security Council spokesman John Kirby speaking over the weekend, saying the administration would like to see a buyer for the app from its China-based parent company ByteDance. The timeline for the legislation becoming increasingly uncertain after facing more questions in the Senate. The bill was passed overwhelmingly in the House last week with bipartisan support. I can see how the administration's positioning themselves now, because they're trying to push that this is about a sale and not a ban, as TikTok tries to push that this is about a ban and not a sale, because they're all trying to connect with the same people. The youth vote. And that's the problem right now for this administration.
Which is going to be a real problem based on my anecdotal research over the weekend, because this was a heated debate all weekend with a host of people who might fall into the demographic that they care about.
Where did it land?
Not good. Not good. It wasn't great. I mean, they just sort of, free speech questions. This is how people make money. This is how people communicate with friends. This is how people engage with the world. I'm struck by the fact that we're not working with data from the government about the national security issues. They're not saying these are the precise issues that we need to solve. They're saying it's a national security concern, which is doing a lot of heavy lifting. What I would like to see is more specifics put out there, and then specific solutions to remedy them. Because otherwise, how do we know we're not, I don't want to say McCarthy era, but how do we know we're not in another sort of witch hunt to figure out who's good and who's bad and who's an acceptable buyer and who's not?
The only thing I know about this story is time. This is going to take a long time to work out, and much longer than we thought maybe a couple of weeks ago. Let's finish on this one. New data beating expectations out of China. Industrial output rising 7% year over year, with retail sales also growing 5.5% compared to last year. The data giving a lift to Chinese stocks, but weighing on bets for government stimulus as concerns remain over consumer confidence and the troubled property sector. Bloomberg's Damien Sassad joins us around the table for more. Damien, good morning.
Good morning to you.
How impressed were you by this data out of China overnight?
Not very. I mean, we had two beats and a miss. I mean, the retail sales figure actually was a miss, but we also had unemployment ticking up to 5.3% annualized, which is kind of a big deal, right, in China. But I think, quite frankly, the PBOC and the Chinese got to be more focused on the BOJ tomorrow. And I'll tell you why. Because the CNY and the JPY are both funding currencies, and they're one and the same, right? And look, the bar for the BOJ to out-hawk this market is very, very high. You've been talking about it all morning. Kitchukes as well. I agree with them. They're going to have to do something to YCC, the balance sheet, and they're going to have to lift rates, I think, for JPY to really appreciate in this market. If it doesn't, then look for CNY to depreciate as well.
Why didn't you just tell us you want to talk about the BOJ and not China?
They told me on Friday. Chris and Amy told me I was talking about the BOJ today.
I wasn't every single time just asking himself his own questions. So we're going to continue the trend.
It's more important. No, but seriously,
we'll go there.
All things considered, we're still waiting for more from the Chinese government. We're still waiting for more stimulus. We're still waiting for something on the property front. I mean, you saw property investment numbers were, they were not well. They were not good. So, I mean, it's the same old story in China. There's nothing really market moving there. The only thing that's going to move this market, move yuan, from 720, which is where it's been, to something on the order of 715 would be a really hawkish BOJ, and I just don't think we're going to see that.
Let's stick on a BOJ. Bramo, I think, asked the most important question. What happens if they don't hike tomorrow morning? Where does that leave dollar yen?
Well, I'm not convinced they are going to hike, even though the market thinks 90% probability of that. I think they might do something on the foreign purchase program and on YCC, which will be just as meaningful. 2 out of 3 ain't bad, Jonathan. So I think, again, it's buy the rumor, sell the news in Japan. It's been this way for as long as I can remember. And I think look, you're right. There was a lot of talk heading into this meeting. The data was pretty strong. I think they've really kind of telegraphed what they want to do already. I'm talking about the Bank of Japan. So, again, the market's desensitized. Again, it's like gradualism in Japan. It's buy the rumor, sell the news. And look, the Japanese yen has depreciated 1% to 2% in the weeks following just about every BOJ meeting in recent memory. I kind of expect more of the same. I think the market does as well.
So I'm not going to let you get away with this. You don't like talking about China. And I find this really interesting because you focus on emerging markets where China was such a big part of the investing thesis for so long. Is it because investors aren't interested, or is it because it all hinges with sort of central planning and how much stimulus they put out there, which is basically a moving target and an unknown?
I think it's two things. I think it's the data and the lack of confidence and reliability of the data. I think that's first and foremost. As an analyst and a strategist, I rely on data points, and the data points are subject. I think, quite frankly, coming out of China for me to hang my hat on, to really trade meaningful dollar amounts on. And then secondly, you're right. I mean, I just think, it's been, kind of this lack of transparency, this opaque nature, the fact that you're right, from an ownership and an investor perspective, it's very difficult to make the case for China in this environment. So you're right, the attention has not been there. But other central banks, other markets across EM and other markets like commodities are a great way to play the China story, which, I mean, look, if you look at inventories and new orders globally, I think the PMI, the flash PMI data this week is really, really important for currencies because people aren't looking at it. And we're seeing the global manufacturing cycle sort of expand beyond the U.S. and into other shores. And for me, I think, you can kind of play the China story through commodities, which you're right. I mean, look at crude oil last week up 4%, copper was up 5%. I mean, these are big numbers.
And they did see an outperformance when it came to industrial output in China, possibly because of some of the fiscal support. Yeah, sure. I mean, you can raise questions about that. But just to build on what you're saying, are you suggesting that some of these other developing markets have just as much of an impact on things like the commodity markets?
Absolutely.
Because they're becoming a bigger proportion of the overall global economy, and that it's not necessarily the behemoth, I'm talking about China, that it once was, in directing some of the trends in your world.
Well, you mentioned the inflation data last week, and what was interesting, it was core goods that really rose. It wasn't core services as much as people would otherwise think. I mean, in fact, core services didn't come up that much. But let's fast forward to this week and look at your commodity producers. Look at Brazil. Look at Colombia. I mean, they're going to accelerate their rate cuts from 50 to 75 basis point increments this week. They're going to do that. So the market expects them to do. This tells you that despite the fact that, you see things kind of maybe a little bit rosier in China off this activity data, deflation is still real, and it's being exported to the rest of the world, and it's giving these central banks in Latin America the ability to cut rates that much more aggressively. Don't get me wrong, their base rates are at double digits. Their real yields are much higher. They have much more scope to cut rates, but that is the environment we live in now. So if you're looking at real yield differentials and you look at China, I mean, real rates in China are going to be negative for the foreseeable future. That's not changing, and so from a funding currency perspective, it's kind of hard to get all bowled up on the yen here.
Did you watch the golf yesterday?
Of course. That
Wind
lip out on 18 was terrible, I know.
Wasn't that heartbreaking?
It was a heartbreaker, I know.
I was getting choked up. They were talking about his late mother before the putt, getting there choked up, trying to cheer this in.
The interaction with him and his caddy the entire weekend was incredible. Clark and him, the way they talked through their shots, and if you watch it like I did, they really were.
You found
and Schauffele was, we always, but Schauffele also was there till the very end. He gave up that 5 strokes.
He's been trying. He's been trying all day to get us someone.
I just wanted to share it with someone.
Yes, you did.
Just wanted to share it. Scotty Scheffler at the moment is just ridiculous.
Oh, he's so good.
Just ridiculous. Damien, it's good to see you.
Yeah.
You thought you were coming to talk about the BOJ. Everyone else thought you were coming here to talk about China. I always knew we'd talk about the golf. Damien Sasser, thank you, sir. Let's get you up to speed on stories elsewhere this morning. Let's get to your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Secretary of State Antony Blinken warned of a, quote, flood of false information ahead of a busy year for elections worldwide. Speaking at a summit in Seoul, Blinken warned that authoritarian governments were going to meddle in elections, and the U.S. would keep pressing to disrupt misinformation efforts from the likes of China and Russia. Big advancements in generative AI are fueling growing concerns over fake content influencing voters. President Biden is preparing to roll out the toughest ever pollution limits on America's cars. It's a bid to accelerate EV sales. The EPA is set to finalize emission limits in the coming days. It's seen as key to help the U.S. fulfill its commitments to the Paris Climate Agreement. The move does pose a delicate political act for Biden, who is trying to court voters in the swing states of Michigan, including auto workers who might be uneasy about a quick transition to EVs. And the March Madness games are set. Millions of fans now set to try to correctly predict 67 college basketball games for the elusive perfect bracket. Defending champions UConn are one of the year's top seeds alongside Purdue, Houston, and North Carolina. No fan has ever completed a March Madness bracket perfectly, with the NCAA saying the odds of doing so equate to about 1 in 9 quintillion. And that's your Bloomberg Brief. John.
Danny, thank you. I've tried a few times. Dreadful.
Yeah.
Even outsourced responsibility to pick the bracket to someone who knows what they're doing. Still dreadful.
That's the whole reason why people do it. Isn't it total luck? I mean, there's really no skill. That's what I've just determined based on my personal output.
You're relying how focused students are the night before on the game in front of them. Yes. Is that what makes it tricky?
I just know that when I've tried, it has been a failure.
This is what Damien really wanted to talk about, by the way. This was it.
This is one year where I have no comment on the NCAA tournament. It's going to be really, really tough. Really, really tough.
Because
3 of the top number 1 seeds didn't even win the conference championships. It's very parity.
You give us some tips in a commercial break. Up next on this program, a big week for central banks.
And I don't think Powell and his Fed want to have a legacy of either cutting too soon or staying at the higher levels where we are now relative to where we were before for too much longer.
That conversation up next, live from New York City. This is Bloomberg. Stocks on the S&P 500 positive here by 0.4%. A lift in this equity market. Yields unchanged. 430.44. The euro in and around 109. Talked lots about dollar yen already. Dollar yen's on a 5-day winning streak. That's 5 days of yen strength, or rather yen weakness, going into this. And you'd be expecting at least the other way around. You'd be looking for strength. We've been getting anything but.
Well, there's really a question of, first of all, if they do normalize for the first time in 17 years, then what? Does that matter if they don't necessarily move away from zero, and if that's it? And oh yeah, by the way, there are signs that the economy is kind of stabilizing and not necessarily accelerating. So a lot of questions here.
That is the longest losing streak for the Japanese yen of the year so far. Dollar yen 149.17. Under surveillance this morning, a big week for central banks.
And I don't think Powell and his Fed want to have a legacy of either cutting too soon or staying at the higher levels where we are now relative to where we were before for too much longer. That said, we continue to think it's a second half of the year when we see the rate cuts happen.
Here's the latest this morning, 2 days away from the Fed rate decision, between meetings from the BOJ and BOE this week. Lindsay Piegza of Stifel writing, quote, should inflation remain leveled off at 4% near term, the Fed is likely to extend its position on the sideline. However, should momentum shift to the upside, the Fed may be forced to re-engage with further rate hikes to quell elevated price pressures. A conversation I'm sure you want to hear begins right now with Lindsay Piegza. Lindsay, the chairman wanted to gain confidence. Has he gained confidence, lost confidence, or retained confidence since their last meeting?
I think right now the Fed is at the risk of losing confidence because the Fed was very clear that inflation was on this disinflationary trend. We were headed back to 2%. They opened the door for the conversation of rate reductions too soon. And now what we've seen is that the inflation data is uneven at best, with some indications of price pressures gaining momentum at the start of the year. This has not only potentially shelved that expectation for a near-term rate cut, but as you just noted, should we see inflation reverse course and move back above this flattening trend of 4%, the Fed may be forced to re-engage in additional rate hikes, something they certainly don't want to do, again, as they've turned the focus, shifted the focus to an eventual rate cut.
Lindsay, let's just sit on that for a second. Where is sort of the threshold, the bar for them to actually re-engage even with the idea of rate hikes at a time where most people just think that they're just going to keep rates where they are for a longer period of time?
Well, to be fair, I do think the bar is pretty high for that. We would not necessarily need to see inflation just teeter out at the current trend, as I mentioned, nearer 4%. But we would have to see a meaningful retreat in that downward pathway. We would have to see 3 to 4 months, I think, of acceleration for the Fed to really feel that pressure to re-engage in rate hikes. Barring that scenario, inflation failing to re-engage in that downward trend, I think this simply forces the Fed to the sidelines for much, much longer than the market is anticipating.
There's a real question here about whether they do give some sort of sense of the new post-pandemic economy. Do they start talking about a higher neutral rate that, say, is within the 3 and the 3.5 range? Or, as Urian Timmer of Fidelity said, maybe even 4 to 4.5% over the weekend. Where do you think they stand on this? What do you think is the correct outlook for them to kind of project?
Well, I don't think the Fed is going to give us much indication of where they anticipate the stopping point, where they anticipate rates to continue to fall to a neutral level. But that being said, I do think the Fed has been very clear that when they begin to engage in rate reductions, it's going to be a very slow and tempered pace back to a neutral level. They've never indicated that this economy needs additional support or stimulus as we move into easy policy, that easy policy range. And so I do think that, again, the market is underappreciating underappreciating the Fed's willingness to not only delay that first rate cut, but also the very tempered and potentially disorderly pace of subsequent reductions relative to earlier cycles.
Can we just interrogate the consensus belief that June is the month that they're going to cut interest rates now, Lindsay? What backs that up? And what do you say to people that keep saying the same thing over and over again? June, June, June.
Well, if we look at what investors have been expecting, investors had been preemptively calling an end to rate hikes for the past 2 years and pricing in rate reductions that have yet to materialize. Now, I do appreciate the market capitulating to the notion that March is off the table, pushing out to May, pushing out to June. So the market is starting to absorb some of this more patient message from the Fed. But even with June more closely aligned to what we saw in the December SEP, or that summary of economic projections, I do think this still, too, is overly optimistic in terms of expecting the Fed to initiate that first round rate reduction. Our base case remains, as it has before the turn of the new year, 2 rate reductions in the second half of the year, separated on a quarterly basis as opposed to a meeting-by-meeting basis.
Lindsay, last time we spoke, you said look out for retail sales. Retail sales will be important. They've been weak now for 2 straight months. How much weight are you putting on that?
Well, I don't necessarily agree with the assessment they've been weak. We certainly saw a sizable miss at the start of the year, but largely reflecting one-off weather in variables. February did fall short of expectations, but it was a welcomed rebound from that weakness in the first month of the year. I think this still tells the storyline that the consumer is resilient, but with a welcomed amount of cooling. We're not seeing an overheating demand level on the consumer side. This is a welcome step for the Fed that is desperately trying to tame inflation, not just on the supply side, but on the demand side as well. And should we continue to see very robust numbers on the consumer side, it would have been more clear that the Fed had stopped short of a sufficiently restrictive level. So this cooling, still positive, but cooling level of activity is actually the most positive indication that the Fed could anticipate.
Interesting. Steve Rashuda of Missouri was on the program in the last week or so, Lindsay. He's in a similar camp to you, except he doesn't think they cut interest rates at all in 2024. He acknowledged one thing, though. This is a Federal Reserve that wants to cut interest rates. And, Lindsay, I just wonder whether they start to move the goalposts, as they have done a few times over the last few years. They were talking about Supercore. Supercore looks hot. You don't hear about that so much anymore. I wonder if we hear less about month over month and hear a little more about the progress they've made year over year. Would you expect to see that in the news conference, and what kind of signal would you take from that?
Well, that's going to be a very dovish tone if we do see the Federal Reserve Chairman focus on some of these maybe non-key measures of inflation that we'd previously been top of mind. But I think the important thing, too, is that once the Fed does initiate that first rate reduction, that does not mean that they continue on that pathway. What we could see is the Fed capitulate to market expectations with 1 or 2 rate reductions in the second half of the year, followed by an extended pause. That, too, is very much an option, and I think that might allow the Fed to walk that delicate line in terms of fulfilling that expectation of a rate reduction, but not getting too far ahead of itself if inflation remains above trend.
Got it. Lindsay, thanks for joining us this morning. Looking ahead to the Federal Reserve. Lindsay Piegza there of Stifel, almost echoing what we heard from Raphael Bostic of the Atlanta Fed, that we can go once and maybe just wait and see. It doesn't have to be the beginning of a big rate cutting cycle. And based on the revisions we've seen on Wall Street from Wall Street economists, feels like that's the direction to travel from them as well.
That's going to be a fun news cycle. Wow, when are they going to cut again? They're not going to. When are they going to cut again? Well, let's predict. Wait, just stop, right? Relax. But then this is where you really have to start talking about longer-term neutral rates. That's how you guide the market to where you're going if you're looking at forward guidance. I also wonder at this meeting, they're supposed to talk about the balance sheet. So let's just sit on the idea of watching paint dry for a second. We've seen the balance sheet fall by about $1.5 trillion, still $7.5 trillion. Do they stop the runoff now, even though things are kind of heating up? I mean, can they signal without signaling that they're maybe getting a little nervous?
I love the difference between how they talk about QE and how they talk about QT. QE is highly stimulatory and QT does nothing.
Correct.
You notice that? That seems to be the comms effort of the FOMC.
Well, and Seth Carpenter, actually, of Morgan Stanley, had a whole piece this weekend explaining why that's possible, that it's completely different. And at the same time, is it?
One is like watching paint dry, apparently, and the other is just sort of super stimulatory and it's going to save the world.
It's gasoline.
And send stocks to all-time highs and all that stuff. Coming up in the next hour, Michael Schau of Market Field, CS Venkatakrishnan of Barclays, George Ferguson of Bloomberg on Boeing, and James Camp of Eagle Asset Management. A lot more still to come from New York City equity futures, session highs positive by 0.4%. This is Bloomberg.
If you look at the momentum in the US data, they've certainly been weaker in recent weeks on the activity side.
We're seeing economic growth moderating. Yes, it's been resilient, but if you look at the underlying dynamics, there is some slowing.
There's a lot of parts of the market that haven't been participating.
I think that there's a non-zero probability that we find ourselves in an environment where demand continues to slow more and more.
Things are good. It's just that they're not as great as people would like to see. We're not there yet. You know, we're in the car, but are we there yet? Not yet.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I absolutely love John Stolfus. He's the most laid-back bull I've ever met.
Are we there yet? It's like being in the car. No, not
5,400
yet.
on the S&P. That was like 20 percentage points ago.
Yeah, he's crushing it.
Super chill. From New York City this morning. Good morning, good morning. Totally like you, Bramo. Just like you. Equity futures on the S&P 500. Where are we? Session highs, positive 0.4%. Just caught up with Lindsay Piegza of Stifel. This is what she had to say. We've opened the door to reductions too soon at the Federal Reserve, and there is a risk, and I stress risk, not a base case, but a risk that they may be forced to re-engage at the Federal Reserve with rate hikes later this year.
So that's not consensus. Let's just put that out there. There is, however, a consensus building that maybe rates are going to have to remain a lot higher for a lot longer. And that is sort of the new consensus that I wonder, has it fully been baked into equities yet? That, I think, the jury is still out.
Slightly been priced into the bond market, that's for sure. So let's take the bond market last week. Monday, Tuesday, Wednesday, Thursday, Friday. Yields up and away by more than 20 basis points on a 2-year maturity, on a 10-year maturity as well. So we start this week with yields very close to the highs of the year. And then you look at the equity market performance. We were down 0.13% last week. We were down 0.26% on the S&P the week before, in the face of a real repricing taking place in fixed income.
And this was driven in large part because leadership's going to lead, right? You got basically have the winners going to keep on winning. And that's what we've got basically for the whole of this year. Every time there's a hiccup or a concern, guess what rallies? The Magnificent Seven. That's why I think Ben Lallier was talking about how today, when we kick off this GTC conference, the developers conference for NVIDIA, it might be more important than the Federal Reserve. Because if there is any semblance, any iota of a sense that maybe we are getting some sort of slowdown in the AI craze, could that crater single-handedly some of the rally we've seen?
More important to watch Jensen than Jay, according to Ben Lallier of eToro earlier this morning. One thing that's not rallying is the Japanese yen. Dollar yen is grinding higher for 5 days now, 5 consecutive days of yen weakness, which is impressive in the face of the first interest rate hike we're about to see since 2007 tomorrow morning. It's a double header of big central bank decisions this week. I know there are some others elsewhere, and we do call them second-tier central bank decisions. There are 2 big ones, the BOJ and the Federal Reserve. The BOJ up first.
I do like that you pointed to Kit Jukes of Societe Generale, who, and I'm paraphrasing now, hey, Bank of Japan, you realize this is important, don't you? Basically, I hope the yen understands it's a historic moment, which raises this question. Will the Bank of Japan meet the moment by giving some sort of roadmap of what's ahead? Or are they just going to kick the interest rate to zero? Or are they going to do nothing? To me, the idea of this pair has been so overanalyzed and talked about and then disappointed with respect to a Bank of Japan moving at the pace of a snail, that I understand the reluctance to really make any bold moves.
It's just stuck there at around 150, at about 149 right now. The broader price action elsewhere on the S&P 500 positive by 1/3% on the S&P, very close to session highs, trying to bounce back from last week's very mild marginal loss. In the bond market, 430.63, unchanged this morning, anything but over the last week. That is a real move higher we've seen on the 10-year yield over the previous 5 trading sessions. And Lisa, you're talking about dollar yen unmoved. Euro dollar, guess where that is? 109 exactly.
It's the most exciting pair ever. I mean, look, this has been a year of really marginal moves, particularly when it comes to the macro trades. When you talk about, for example, some of the currencies, which is interesting in and of itself. Why has it been so quiet when you have real divergence when it comes to an economic perspective? Has it all really been baked in? What will it take to really create some volatility, some sort of trading action? El Salino is saying to us, yeah, it's been pretty slow.
Boring? Would you go as far as saying it's boring?
I didn't want to use the B word because that's sort of,
they call it slow, you call it boring.
Well, I don't want to call it boring because nothing's boring. You can find really interesting things.
Of course you can. This hour will not be boring. Coming up, Michael Schall of Market Field Asset Management on what to expect at Chairman Powell's news conference. The CEO of Barclays, CS, Venkatakrishnan, on the bank's restructuring plans, and James Camp of Eagle Asset Management on why he thinks it's likely the Fed passes on cutting. We begin with our top story. Following 2 weeks of losses on the S&P 500, investors turning their attention to Wednesday's Fed decision. Michael Schall of Market Field Asset Management writing this: we may see some criticism of the exuberance being shown within asset markets, or at least some pressure on Chair Powell to comment on this issue during the presser. Michael, I'm pleased to say, is with us. Michael, this has been the Lisa question of the week. Are we going to get some criticism of financial conditions being too easy? Are we?
I realise after writing that, but pressure is a bit of a tongue twister. But look, I think that is the question. I mean, I think the Fed unnecessarily moved its guidance back in November, December. I think no one has a crystal ball. I think if they knew what the economic data would have been over the next 3-4 months, they never kind of would have moved it. And you could say, OK, nothing really happened. But asset markets have behaved very, very differently since November, December.
So, well, no, I would like to know why you think that this is different, that suddenly he's going to care now when he didn't care in December.
I think there may be some pressure put upon him. I mean, I think his press conferences have been fairly easy for him since November, December. I think he's sort of been in control of the narrative. I think he's started to be seen as a successful federal board chair. Asset markets have been strong, but everybody kind of likes that. I think that you run the risk now that if you continue to promise, if you continue to guide lower, if you continue to say we're going to use whatever opportunities we're going to take to cut rates, the asset markets move uncomfortably higher.
Which is a reason why I think a lot of people are wondering if they give some sort of guidance longer term. I just wonder, just to put a bow on this, do you think that Jay Powell is more important than Jensen Huang today when he speaks at the NVIDIA conference? Is just to sort of say, put a bow on that?
I mean, they're completely different issues to me. I think NVIDIA controls the NASDAQ, and you could say the NASDAQ controls the S&P, but the economy is controlled by the Fed.
Neil Dutta of Renmark just wrote in. He made the point about stocks still doing OK in the face of getting rid of these interest rate cuts because of nominal GDP being a whole lot stronger. And in this environment where firms can make money, why would stocks tank even without the rate cuts? Is that your view? Can you retain that sort of bullish view on stocks regardless of what the Federal Reserve is up to?
I mean, I think nominal GDP is about 5.5%, which is about where the Fed is. The other side of nominal GDP is triple B yields are almost exactly where the Fed is. I mean, this is a pretty favourable operating environment for corporate America.
So what do you like right now in equity markets with that in mind?
You know, I like that there's some life finally in the sort of economically cyclical stuff, because if the economy is OK, that stuff should really be being rewarded. I think energy's had a pretty lousy 12 to 18 months, but has quietly had a pretty good, doesn't feel like a good start to the year, but you look at it now, it's starting to look OK there.
I want to sit on that for a second. The rally last week, it was a sell-off more broadly, but energy stocks rallied tremendously. Is this a good rally for the economy, or is this a bad rally, considering that it really speaks to the reinflation in goods?
Well, it depends which part of the economy you're in. The people making the goods, I think, are going to have a pretty decent year. I think at the end of it, there's squeezes on other sides of it. But look, you've had this crazy story of COVID, and we all understand the massive reflation that came with it. And then you had a sort of very favourable withdrawal of those pressures, and I think you're going to have a sort of mini bump now. It's going to be nothing like COVID, thank God. You're going to have none of the sort of crazy distortions that we had, but you've had a very long destocking cycle, which looks like it's finally come to an end, and you're going to see a reinvigoration, I think, of the commodity complex and the people that benefit from.
I just want to make that really clear. You think the disinflationary trend of the last 6 months is over?
In the goods economy, yes. The service economy is completely different. The service economy never really had a disinflationary trend. There's lots of ideas out there about shelter and what that's going to do. But if you look at the sort of goods economy, it's had a completely different experience over the last 18 months to the service economy. I think that's bottomed. And I think you will get inflationary pressures in goods inflation.
If you had to take a bet this year, how many cuts over the Fed?
Somewhere between 1 and 2.
Really that low?
Yeah, I think they will really try and cut sooner or later. And I think that's probably just about it.
Michael Shao of Marketfield. Michael, it's good to see you. Michael Shao there of Marketfield Asset Management. Equities right now on the S&P near session highs, up 0.4%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Nasdaq stock market is investigating connectivity issues this morning. Pre-market trading on the exchange was disrupted for more than 2 hours. In a statement, Nasdaq says it has determined the root cause and it's working on a fix. Bloomberg data shows no trades printed on the Nasdaq global market since 4:09 a.m. New York time. The exchange says any unacknowledged orders on its Rash Fix system have been canceled and back to customers. Secretary of State Antony Blinken warned of a, quote, flood of false information ahead of a busy year for elections worldwide. Speaking at a summit in Seoul, Blinken warned that authoritarian governments were going to meddle in elections and the U.S. would keep pressing to disrupt misinformation efforts from the likes of China and Russia. Huge advancements in generative AI are fueling concerns over fake content influencing voters. And North Korea fired multiple ballistic missiles in a defiant show of force coinciding with that Blinken visit to Seoul. Tokyo's Ministry of Defense says North Korea fired 3 missiles towards waters off its east coast on Monday. They say it flew some 350 kilometers to land outside Japan's exclusive economic zone. The U.S., South Korea, and Japan all condemned North Korea's first ballistic missile test in about 2 months as a threat to regional security. That's your Bloomberg Brief, John.
Danny, thank you. Up next on this program, it's a new era for Barclays.
We'll continue to strive for efficiency in cost, improvement in the quality and types of revenue, running the business well. People are looking for a partner and a counterpart who's not just a U.S. bank. And if they had to pick one, they tend to pick British banks, and we're a strong British bank.
We will catch up with the CEO of Barclays up next here in New York City. From New York this morning, good morning. Massive week coming up. Every time I say that on a Monday morning, I know I say it almost every week, but Federal Reserve, BOJ on deck, lots of data in between. Massive week coming up. Equity futures on the S&P 500 near session highs, up by around about 0.5% on the S&P this morning. 10-year yield just up every single day last week. A move of more than 20 basis points on a 10-year, 2-year as well. 430 on a 10-year, 470 on a 2-year maturity. Under surveillance this morning, it's a new era for Barclays.
I think it's going to be a bumpy year, but more than anything else, we've got to be resilient. We'll continue to strive for efficiency in cost, improvement in the quality and types of revenue, running the business well. We are the leading investment bank domiciled outside the United States. People are looking for a partner and a counterpart who's not just a U.S. bank. And if they had to pick one, they tend to pick British banks, and we're a strong British bank.
Here's the latest this morning. Barclays launching a bold 3-year plan for shedding costs as well as boosting and diversifying revenue, aiming to return at least $12 billion to shareholders by 2026 through dividends and buybacks. The bank also announcing a wide-ranging overhaul of its business into 5 operating divisions from 3 previously. I'm pleased to say that joining us around the table is the CEO of Barclays, CS Venkatakrishnan. Venkat, great to see you, sir.
Very good to see you.
Particularly here in New York City. The stock is doing really nicely, so let's start with some good news.
Yep.
We've rallied since the middle of February pretty aggressively, I would say, up by something like 20% last time I looked yesterday evening. Do you think that's evidence that shareholders are buying into your vision?
It's the early stage of that evidence. What's most important for us is this plan. And it's a plan to increase our ROTE to 12% from the 10-ish it is now. It's a plan to return about £10 billion to shareholders and capital distributions. And it's a plan to have a broad, diversified bank that's a global banking leader centered in the UK, with an investment bank that is going to 50% of the bank from around the 60% it's now. So our job is to, having created the plan, is to execute it. and the share price hopefully will follow.
Can we get into the investment bank? And you talk about diversifying revenue and leaning maybe more into advisory fees. Is the talent there on board in the investment bank already to make that shift, or do you need to hire to make that happen?
It is substantially there. You know, we made some organizational changes last year. We have new leadership in the investment bank. We hired a bunch of very skilled bankers in healthcare, in technology, in the energy transition. And that has already started to have its effect. Last week, we announced EQT's sale. We advised EQT on its sale to Equitrans, Equitrans on its sale to EQT. And so we're beginning to feel the momentum from those hires.
What do you think it is about investment banking in and of itself that makes it a less attractive proposition to remain at the same size versus, say, advisory fees?
Well, one of the things is when you move into advisory fees, you start getting a better return on your capital because you're not outlaying as much capital per unit of revenue as you do if you're purely lending. Now, lending is an important part of what we do. We are a very big player in the fixed income markets, in the debt capital markets, as well as fixed income trading. So lending is a part of what we do, but we're just trying to broaden it into more advisory and more equity-related revenues.
How much is this sort of a new model of banking that's basically taking all of Wall Street and a lot of the global banks, too, which is trying to cater to the whole client rather than, say, go after specific deals and be focused on, for example, being at the top of a league table?
Yeah. I think it's an important part of the shift that's happening. And it's happening because previously in the investment banking side, we were working with corporations. And since then, we still work with corporations in a very big way. But in addition to that, you've got the financial sponsors and the sovereign wealth funds. So the growth of concentrated pools of capital makes it important to have that full relationship with those players in the market.
Venkat, every time we sit across the Barclays box, I think we ask the same question. I can think about when Bob Diamond left that morning, then Anthony Jenkins came in. I remember I was actually at Barclays HQ the morning Jenkins got fired. I was sitting down with the chairman and we talked about the same thing, the investment bank, the future of the investment bank. Do you find that's more of a media obsession than it is an obsession with investors? Where does that question come from?
It's a legitimate question. And in our Investor Day 4 weeks ago, I tried to address it directly as well. I think, first of all, it's important for Barclays to have an investment bank. We are good at it. We are the largest investment bank outside the top 5 in the US. I think it's important for the world to have a counterparty that's not just a US bank, and they would prefer a UK bank when they do it. It's an important source of revenue for us, and as I said, we are good at it.
Why is it important, and why do they prefer a UK bank? Why is it important to have a bank outside of the US? What are the benefits of that?
Well, you're diversifying your counterparty exposure in a national way as the world is becoming a little more deglobalized. You know, London has been historically a great financial center and remains one so, and it's a very important one. And then UK law governs a lot of financial contracts. So all those three things make it very attractive to work with a UK bank.
Does it also make it incredibly difficult to compete outside of the UK or, say, in the US when you've got a JP Morgan that's dominating absolutely everything?
Well, look, there are very large banks that are in the US. The world is big enough for all of us. We act like a US bank when we are in the US.
Well, when you act like a U.S. bank with a very specific focus, you've talked about in the pillars, the 5 pillars in reorganization, the importance on focusing on consumer lending, consumer spending. Recently, you offset some risk from your credit card portfolio. There is a real question here about where you see an opportunity to lend in the consumer space at a time of uncertainty in the cycle.
Yeah. So we view the consumer space in 2 ways. In the U.S., we've got a great credit card business, but it's very specialized on partnership cards. We've got 20 corporate partners, very blue chip corporations, 20 million underlying customers. We're looking to continue to grow that partnership card business in the U.S. in a measured way because it has great synergies with our investment bank, and it's a great overall business for us. In the UK, we have strength across the consumer franchise. and in small business banking and corporates. And there, it's sort of, it's our homeland. It is our home turf, and we are very strong, and we look to increase that strength.
Well, I guess here's the question. Is there basically more emphasis on growing in the United Kingdom outside of the U.S., and the U.S. effort's going to be much more bespoke, focused on very clear sort of verticals rather than the whole picture in the same kind of way as the U.K. or elsewhere?
Yeah, so the way I think about it is that we've got a complete banking presence in the U.K., touching customers from the very largest corporations down to individuals, and offering them the full range of financial services. In the US, we offer investment banking services very well, trading and for banking, and as I said, a very good specialized partnership credit card business.
We had a rate shock, big time, on both sides of the Atlantic in the last 12, 18 months. What we haven't seen is the credit stress off the back of that. Yeah. As you look across the business at the moment, corporates, consumers, the US, the UK, are you seeing any of that emerge at all?
You're seeing small signs of it in the consumer side, with just a tick up of delinquencies off the COVID lows. And I think, look, employment remains extremely strong, or unemployment is low. You're seeing the effects of inflation, and you're seeing the effects of the wearing off of the consumer stimulus that you had during COVID. And so you're seeing a small increase in delinquencies in the consumer businesses.
Is there a pocket of risk that you're being super vigilant about at the moment, that maybe you're pulling back on lending around that particular area of the economy?
Not really. I mean, I think as an overall matter, taking the very big picture, the economy is stabilizing. It looks like on both sides of the Atlantic you're having a softish landing. Employment, as I said, remains strong, and overall credit statistics and the corporates remain strong. So generally, we are constructive towards lending.
I wanted to finish on the City of London, if I can, if you'll indulge me. Barclays and its roots of Barclays go all the way back to the late 1600s, early 1700s. We're talking about centuries. Yeah. The City of London, for a long, long time, has been at the epicenter of global finance. Do you see that as under threat in any way, shape or form? Do you think the UK has taken that for granted over the last several years?
I don't think the UK has taken it for granted. I think it's very important for the UK. I think the UK understands that. I think politicians on both sides in the UK understand that extremely well. So no, I think there's a lot of support for the City of London.
This raises a question of where we are in the economic cycle, where it is strongest. And this week we do get a Bank of England decision. Is it beneficial if rates stay higher for longer, or do you want them to come down to support the economic growth and maybe some of the engine that John was talking about?
So ultimately, that's a decision they have to make. It's very important to balance.
Sure. But,
yeah.
You know,
you've got to make a call. I actually think a little prudence and waiting a little is not a bad thing.
You think there is an option there to wait a little longer then? Why do you think so? Why is the bigger risk maybe to cut too soon and not to hold too long?
Well, I think that the economy is stabilizing. Employment is still robust. Inflation is coming down. So I think on the balance, it might be more prudent to wait a little longer. Now, our house view and that of many others is for more rate cuts over this year.
Would the same apply to the US? The same characterization of the situation?
I think so, yeah.
But just, would that be good for you? Are high rates good for banks, or are they bad for banks? This has been a perennial question.
Stable rates are good for banks.
Venkat, very diplomatic. We appreciate your time, sir. It's fantastic to catch up and
thank you.
See you here in New York City. Thanks for being with us, sir.
Here. Thank you.
C.S. Venkatakrishnan there of Barclays on the situation, Lisa, from the United States to the UK, the differences, the similarities, and the path forward.
It's a big world. There's room for all of them. Here's the question. How do you sort of rearrange when the pools of capital, concentrated capital, are shifting globally in terms of where they are and how you cater to them? Thinking of sovereign wealth funds, I'm thinking of just wealth management and how much that's ballooned over the past few years, and how banks are rejiggering their entire investment bank. I mean, we're hearing that from Barclays, from Morgan Stanley. We're hearing that from also Citigroup, you know, in terms of how they're thinking about the world. It's a shift responding to real shifting pools of capital.
The question on the investment bank just won't go away. And I think it is one part media obsession and then a bigger part just an interest in general over the future of that. But just repeatedly, it just keeps coming up, keeps coming up.
Because traditionally it was who scored the big deal. It was where were you on the league table? And there's a question of whether that is an antiquated model that no longer bears fruit in the same kind of way, especially given the trading and some of the real kind of booms and busts of the past, you know, number of decades. But, you know, ultimately, if you are looking at a new model, it's part of that full service model.
Yeah.
It just has a different tenor.
They've been absolutely dominant for a long time in debt capital markets, and we're looking for a pivot towards more of the advisory stuff coming out of the investment bank in the future. Coming up on this programme, we'll pivot from banks to Boeing. A disastrous start to 2024 keeps getting worse, and it could be about to hit the passenger in the pocket. That conversation just around the corner. Equity futures on the S&P 500 set up as follows to start your trading week. Equities session highs up 0.6% on the S&P 500. Big moves in the bond market over the last week. We start the week on a 2-year in the 470s, on a 10-year in the 430s. Yields just about unchanged on a 10-year maturity. In foreign exchange, the euro slightly stronger, 109 on euro dollar. Live from New York City, this is Bloomberg. Stocks session highs up by 0.6% on the S&P 500, on the Nasdaq positive by more than 1%. We are rallying hard to start the trading week with two things in focus. One, central bank decisions. The other, Nvidia has got a developers conference, and let's just say the enthusiasm is pretty big right now, Bramo, on that particular stock.
I think that's pretty much of an understatement right now, considering the fact that people are looking for all of the applications that you could potentially get from artificial intelligence. We're hearing about how it's going to transform everything from healthcare to banking to the retail sector, Chipotle, for example, and some of the others at a recent retail conference talking about how they can automate more. So the avocado is coming to
the avocado. Is that what it's called?
Yeah. Did you ever see that?
No.
It like cuts it in half, the avocado, and then it
right.
like scoops it out.
Okay.
Because it saves a certain amount of time. So the avocado is going to transform.
How much does that machine cost? I wonder.
It's a good question.
Sort of that. It's not hard.
Well, but that, if it saves a lot of time, what? Do that one more time. That's not difficult.
They twist it.
Well, but if you think about it, if you're doing it, 1,000 times, and you have somebody just sort of opening it up, it could save a staff member. So potentially, instead of investing in a human to do that, you could end up
get the knife and twist the stone.
Would you do that?
Yeah.
You like smack it down?
Well, not aggressively. Not like that. In a controlled manner. In a controlled manner.
They have like special machines anyway.
In the bond market, yields. Don't know how we got to that. Down about 2 basis points on a 2-year, 471. Started the week in the 470s after closing a week there last week. Big move higher in 2-year and 10-year yields. Yields this morning on a 10-year virtually unchanged, just in and around 430 at 429.84. Let's turn to foreign exchange, and then we can set up the BOJ and the Federal Reserve in the week ahead. Dollar yen right now looks like this, 149. Just more yen weakness on the margin. We've had 5 or 6 days of this on dollar yen, which is kind of surprising given that we're looking for the first interest rate hike from the BOJ going all the way back to 2007. Under surveillance this morning, a busy week for central bank decisions. The BOJ kicking things off tomorrow with the nation's first rate hike potentially in 17 years. Wednesday, we get the Fed decision, a pause expected, but Chairman Powell's news conference could provide some insight into the timeline for rate cuts. And Thursday, we get the BOE. Another pause expected there, but a slowdown in pay growth, likely to mean fewer calls for higher rates. Interesting that we just caught up with the Barclays boss. And if you are just joining us, CS Venkatakrishnan, the Barclays CEO, joined us around the table just months ago. Just some insight into how we felt about the Bank of England there, that maybe there are some benefits of waiting. A question we've asked stateside about the Federal Reserve: what is the biggest risk, cutting too soon or holding too long? Clearly, there is a bias there, maybe, that the biggest risk is cutting too soon.
Which seems to be what the market is baking in, this idea that maybe we don't fully understand just how resilient some of the inflationary pressure is. I have to say that the goods inflation is notable. We are done with the disinflation in goods. That's what we heard earlier from Michael Schawel, and a lot of people would agree. So now the question is, do we stay around here, and do they have to hold it higher for longer in order to get it under control and not have to do the worst thing possible, which is cut and then hike again?
Autocado can hold up to 25 pounds of avocados at once, according to the control room.
Yeah, avocados. Yeah, they're vertically oriented.
Right.
And then transferred to the processing device. Look, it's time consuming. If something could just take off the skin, take off the pit, and then you could just mash it, it just is one person or even just a machine mashing. And then if you don't have to pay somebody, tens of thousands, $30,000, $40,000, $50,000 a year to mash avocado, then you could potentially invest in an avocado.
On better customer service instead.
I get the sense that you don't feel like the customer service at Chipotle.
I've never been.
This is also my shocked face.
Never been. In fact, maybe I've been once when it was in London.
It's pretty good.
I don't think I've been in the United States.
This is the type of thing, though, that they're talking about. Avocado.
Okay. Good to know. Thanks for that, Lisa. Shares of NVIDIA are rising in the pre-market ahead of the company's AI conference starting today. The CEO, the speech kicks off the week, a platform he's often used to introduce new products and outline his vision for where the technology is going. Stock's up by 2.8% this morning, which is just kind of nuts. The stock is coming off its 10th straight week of gains, a record rally that's seen the stock had close to 80% so far this year. Just kind of crazy, this rally in this name. We asked Ben Lader of eToro earlier this morning, what is the biggest event for this week? Is it going to be Jensen of NVIDIA or Jay at the Federal Reserve? He said it's the former, not the latter, given the contribution we've seen from that name to this stock market.
True. Of course, the question is why, right? What are they going to announce or what we're going to see? And that's the reason why I pointed to Avocado. I realize that's not exactly AI, but what are some of the adaptations that are going to change business as we know it in different places, and how quickly is it getting developed? And that's where I think that potentially you could see a broadening out in the rally. Other kinds of industries really do well. So this is why it actually is really key. I'm watching this.
We said a few weeks ago it's 5% of the S&P 500 and 99% of the reason to buy stocks. It really feeds into sentiment. I do believe that this name and everything around this name really feeds into sentiment for the whole ecosystem that is AI right now. Well, it's basically based on the enthusiasm around that single name.
It's going to solve the world's problems, right? It's going to change productivity. It's going to make us all have better lives. We can work fewer hours. There's this one stock that's up something like 12 times its original value because of the feeding into some of the processing devices used for these things. Look, we're talking about a technological sea change akin to the internet that people are talking about. How do you price that? And so that's why I think that that's underlying the enthusiasm. And the Fed doesn't matter if you're talking about a technological sea change.
That name is up in the pre-market by 2.7%. Let's turn to Boeing. A disastrous start to the year, and it keeps getting worse. With a busy summer travel season just around the corner, United, Southwest and Ryanair are among the airlines scrambling to respond to reduced deliveries from Boeing. The plane makers focus on fixing quality lapses exposed in the January incident on board an Alaska Airlines flight are causing production delays, which could lead to airlines reducing summer travel schedules and ultimately higher prices for passengers. George Ferguson of Bloomberg Intelligence joins us now for more. George, can we go straight into production numbers? Just how much has this disaster held back production at Boeing?
Well, I think that's something we don't know yet. We've all been trying to figure out. I think the market has largely not adjusted a lot of their delivery numbers yet, but after last week's report from Southwest, I think people will take their pencil to that. We're looking at cutting about 50 deliveries out of Boeing 737 deliveries for 2024. Probably brings them from about a 500 level to a 450. Could come down even a little more. I think some of the effect on the airlines, especially for summer travel season, will be a bit muted. And I think it's because you're getting your deliveries that you're going to use in the summer by March or April as you get an airplane into your schedule. So this whole effect it's going to take a whole year to be felt. So it's not going to all be this summer. The U.S. still seems a little overcapacitized to us, especially for budget seats this summer, which Southwest is one of those major participants in the budget seat category, I'd say. So not sure we're going to see a big move in fares, but it'll firm them for the U.S.
So the good news, George, if I'm hearing you correctly, is we're not going to see a spike in prices off the heels of this, most likely in the United States, because this is going to be a long process. The bad news is maybe next summer we're going to feel the effects of this, and it's a sort of long simmering process as Boeing tries to work this out. Is that correct?
Yes. I mean, obviously we have to see how demand holds up for next summer, but yes, I think the bigger risk is absolutely out there.
So then there's this question of, do we even have a sense right now of whether Boeing is getting on it and actually getting a lot of the issues under control, given the fact that the DOJ seems to be concerned? Investigators have identified problem sites. They have not been able to find a report that they asked for. Where are we in this?
Yeah, I don't think we have a sense that Boeing has it under control yet. I'd say, the commentary coming out of Boeing, they provide no more guidance. So they're not in the process of trying to reassure the markets, and we're still deep into this investigation process. Like you said, DOJ is investigating. Boeing has 90 days to come back with a report to the FAA on how they're going to stabilize their production process. We know they're exploring a purchase of Spirit Aerosystems. Haven't heard anything more on that. That could do something to help quality. I think we're still in sort of the early days of figuring out what Boeing's game plan is going to be and what we think the effect is going to be on the company, on its production. So not much reassurance right now.
George, as you've told us repeatedly over the last few months, the order backlogs at Airbus, at Boeing, stretch years out. And what's less clear to me is how the likes of an Airbus can take advantage of the current situation. When you think about what's happening with Ryanair, United and Southwest, George, what options do those airlines actually have?
They don't have a lot, right? So the airlines that are flying, very single type fleets, all Boeing fleets like Ryanair, like Southwest, it would be a major move for them to take, to move from the 737 to the competitor, the Airbus A320. I'd probably take a decade for somebody to switch their fleet over. It changes their whole game plan, right? They're all built around low cost, very homogeneous fleet, pilots all rated on a single subtype or single types. So I just don't see that right now. I think it's got to get a lot worse. The ones you will see peel away are carriers like United that are flying dual fleets already. Carriers like American that are flying dual fleets already, to use two U.S. examples. Those are the carriers I think Boeing has to be very careful about. They don't want to lose a lot of business with them, and they're starting to lose it in United because, again, the complications of adding another type to their fleet, it doesn't even add another type. They're already flying Airbus. It's easier for them to switch, and some of them are starting to do it.
George, competition concerns are always close by in this industry. That's not new. But it's going to be under the spotlight again, I would say, George, now with this. Given there are very few options, what does the regulator do going forward from here? And not just in the United States, I mean worldwide. How do they fix this?
Well, I think we're looking for the regulator to help, shine the light through, maybe is a way to say it, for Boeing, help them put their production, processes back in place. The regulator has to, I think, also be very careful because, this is a U.S. defense contractor. It's very important to U.S. industry, U.S. aerospace, one of the biggest exporters in the country. So it's a very delicate balance they're doing here. But at the end of the day, I think safety has to take the highest priority, and the regulator has to go that way and make the calls based on safety. But they're really trying to help the company through the process more than trying to hurt the company, which is hard.
In the meantime, as we focus on safety and all that, are the Boeing planes currently going for a discount?
There hasn't been a lot of sales. We looked at sales for February. It was a pretty weak month. I think if you stepped up to take an airplane from Boeing today and you were going to bring an order in size, you could probably get a decent price on it.
George Ferguson of Bloomberg Intelligence. You might not get the plane anytime soon, though. George, thank you, sir. Thank you very much. And that right there is the problem.
Yeah, it's a good price, though. I'm thinking of Michael O'Leary. I'm looking at you over at Ryanair looking for a discount.
You'll get a good price, but you're going to pay for it, aren't you? Because you're not going to be able to fly the plane. You're going to have to reduce capacity, which is ultimately what Ryanair's doing.
Which is the reason why this has actually been speculation that prices are going to go up. We heard that from Helene Becker, that actually airline prices could go up. George Ferguson pushing back on that just a bit. But this really is the tension right now, is that it is a duopoly. And one prong of the duopoly is having issues, and both prongs of the duopoly are having issues just to fulfilling the orders to begin with, even before all the problems. Why do we have this duopoly?
Boeing right now down another 1.1%. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The NASDAQ stock market says it has resolved connectivity issues this morning. Pre-market trading on the exchange was disrupted for more than 2 hours. In a statement, NASDAQ says it determined the root cause, but it didn't go into further detail. Bloomberg data shows no trades printed on the NASDAQ global market starting at 4:09 a.m. New York time. The exchange says any unacknowledged orders on its Rash Fix system have been canceled and put back to customers. Donald Trump's economic advisors have floated 3 names to lead the Federal Reserve should he be elected, according to the Wall Street Journal. In a meeting at Mar-a-Lago, Steve Moore and Arthur Laffer recommended Morgan Stanley executive Kevin Walsh, Kevin Hassett, and Laffer himself. Trump hasn't committed to the candidates, but has soured on Jerome Powell, whose chair ends in 2026. A 2-year slump in the second-hand luxury watch market could be nearing an end thanks to stock market records and the rebound in Bitcoin. The Bloomberg Subdial Watch Index showed prices for the most popular Rolex and Patek models were mostly flat for a second month, with the most in-demand models showing declines of less than 1%. Rolex's GMT remains an outlier, with the blue and red bezel model rising almost 2% in price, selling at more than $20,000 apiece. And that's your Bloomberg Brief. John.
Danny, thank you. Not a fan of that watch at all. I saw you staring at it.
Well, yeah, I'm just trying to understand $20,000, and I typically think it has to be, well, I don't know. Have you ever had a $20,000 watch?
No. I thought you never sell Bitcoin. I thought that was the thing. But you do recycle it into Rolex and Patek sometimes.
Yeah.
Apparently.
Well, maybe it's you.
Up next, you don't want to talk about this, do you?
Let's move on.
Okay, fine, whatever.
Carry on.
Investor surrender to higher for longer.
It's more about the terminal rate. We're actually looking for something now north of 4%, which I think is the kind of more interesting next story to play for.
That conversation up next, live from New York City. This is Bloomberg. If you're just joining us, session highs on the S&P 500 up by 0.7%. This equity market's kicking off Monday rallying hard. In the bond market, yields are not up to much, up to a lot last week. 429.64 this morning, big move higher by more than 20 basis points throughout last week. Under surveillance this morning, investors surrender to higher for longer.
We just recently changed our call. We had a June start to the cutting cycle from the summer of last year. We've now revised that, looking for 3 cuts this year, but it's more about the terminal rate. We're actually looking for something now north of 4%, which I think is the kind of more interesting next story to play for.
It's the latest this morning. The Fed's next rate decision on Wednesday, with swaps pricing in fewer than 3/4-point rate cuts this year, less than the Fed's median projection in December. James Camp of Eagle Asset Management saying the higher risk to markets is the bond market failing to price in a Fed which may not cut at all this year. James, I'm pleased to say, joined us now for more. James, let's get into this then. What backs up that call? What is your outlook for inflation that suggests to you, at least, that they won't be doing much at all?
Well, John, good morning. I think the issue for the Fed is going to be the inflation data twofold. One is, the base effects, which we've talked about, are going to be difficult. The second is I just think that there's more inertia to inflation in a post-COVID economy than the Fed's giving credit for. And for me, when I look at the growth of the economy, I look at the labor market still being relatively healthy, and I look at the inflation not getting to the terminal rate of 2%. I don't see the cut motivation. I think that's the problem that I'm wrestling with is what is the Fed policy cover, if you will, to be cutting rates when what they're doing seems to be working and yet not quite to mission accomplished.
There are two schools of thought here, James. On one hand, you could say the Fed is going to wait for longer to cut rates, and that's actually going to keep the long end of the curve controlled. They'll keep yield in check, essentially, because they'll get inflation under control. On the flip side, some people will say maybe there's just sort of a tacit agreement to keep inflation around 3% in the U.S. economy, and the Fed's going to cut rates because they're less concerned about inflation actually going down to 2%. Which do you think is most likely based on the communication from the Fed so far?
Lisa, I think the truth is we are in a higher inflation economy for the next decade. I think the Fed acknowledging that, to your point, would be wise. I think that would give the Fed some cover to cut rates. And look, the rate environment is punitive for the lower income, the bottom 80% that are stretched in savings, that are using credit card debt, that are seeing those carry costs go up and up. That is not only an economic risk, frankly, it's a political risk. By the converse, these higher interest rates are actually accretive to some of the large corporations that have issued debt at 3%. So it's a very interesting conundrum. I would like to see the Fed come off that 2% terminal rate. I suspect sometime in the early summer we'll begin to get that kind of dialogue, if you will. But I just don't think we're in a 2% inflation world anymore.
Which is the reason why Yuri and Timur of Fidelity came out over the weekend, and I thought this was really notable, saying essentially that the neutral rate has essentially gone between 4 and 4.5% at this point, talking about how the simple math is that inflation, if it settles around 3% and the economy has a soft landing, then the real policy rate should be at least 100 basis points higher than that. Do you agree with that? A 4 to 4.5 Fed funds rate is really what we're looking at for neutral.
I do agree with that, and I think the growth rates and the inflation rates are suggestive that a terminal rate with a 4 handle is likely. And I think the consequences for the long end of the curve, are simply there's going to be less incentive to carry. There's going to be more difficulty in lever trading. And I think the long end of the curve is putting in higher lows, if you will. I don't know that we've breached that 5% 10-year that we had back in October, but investors should be ready and at the switch if we get into a 4.5, 4.75 type 10-year. That's going to be value again, and that's when I think cash should start moving off the sidelines back into the bond market.
Well, let's get into that cash position. So positioning, your 60-30-10, that's stocks, bonds, cash. Is that why you want to retain that option? Have that cash, have 10%?
Yeah, John, I think the cash option is twofold. One is the carry is there, right? We're getting a very handsome yield to weight. The second, I think, more consequential part is the correlation between rates and stocks is very high right now. Until this inflation thing is settled, bonds and stocks trade coincidentally. The yields go up, stocks go down, and vice versa. So we don't want to conflate the risk. I do think the bond market long-term is extremely attractive. History tells us that at a Fed peak, which we were at, that bond market returns for 1, 3, and 5 are unambiguously good. And the other part of the equation is in the dividend aristocrats, those terminal growers, those companies that pay and grow year after year after year, also have a very good track record post-Fed peak. So a little bit of powder dry here in the cash market, but obviously we're being paid to wait.
James, with that in mind, if the correlation is high, why not shift even more into equities versus bonds, or vice versa? Why retain 60-30?
Yeah, I think the one thing that we have to be mindful of is, this could do an about-face relatively quickly on us. The yields in the fixed income market are as generous as they've been, in a decade plus. On the equity side, a higher weight we're simply waiting for Brett to get a little bit better. We are, in our companies, having very good earnings growth. We're having very good dividend growth. That's the objective function of an income portfolio. So all things are being checked in those boxes. But in terms of getting even more bullish, if you will, on the equity side, we're just going to have to see some broadening of breadth, if you will.
What do you expect is going to drive that breadth, James? What's going to underpin that?
Well, I think the recognition, especially for the retirees, that the S&P is not their benchmark, if you will, that income and income generation in a lot of the sectors of the economy are doing well. The income growth is there, and that you can buy these companies alongside the bond and the cash markets and probably have the best income environment for the capital markets that we've had in, like I say, 10, 20 years.
We were speaking with Ben Laidler earlier this morning, and he said underpinning this rally, obviously, is NVIDIA. But he thinks that Jensen Huang's speech today, I believe at 4 p.m. Eastern time, kicking off this conference for NVIDIA, is arguably going to be the most important event of the week. Do you agree that this is sort of important to understand the broadening out of a rally hinged on artificial intelligence percolating into the rest of the economy?
I think long wave, yes. I think short term it's a continuation of the momentum trade. Pardon me. The momentum trade is just a huge part of what's going on in the capital markets. The narrowness is obviously a big topic. I'm very excited about AI. We use it in our business. We see it applications, across the economy. The productivity enhancement of these types of innovations can be game changing. The economy, as you know, Lisa, for the last couple of decades has been languishing with productivity growth. I would point to the Fed and cheap money, the longer conversation. But now the cost of capital is higher. And now the companies have to figure out how to get more efficient. Now that labor markets are tighter and labor has a different seat at the table than it's had, these types of revolutions and transformations in technology give us a lot of hope long term. Now, obviously, for markets, it's going to be an exciting week, and those are going to be near-term catalysts. But I think the long-term hopefulness of the economy is that we are going to have a significant shift in productivity and productivity enhancements, which ultimately is wealth creating. So that's a positive.
James, just quick here. I'm wondering, how have you used artificial intelligence? Have you gotten rid of half your employees and just basically stuck computers there instead?
We have not. But what's interesting is we've more than tripled our business over the last 5 years without additional headcount. We've done it more efficiently. Our business is separately managed accounts, which is technologically intensive, and we have algorithms, and we have Bond GPT and other things that allow us to search, to source, and to get accurate price discovery on a very opaque market, which is fixed income. So it's been growing without headcount increase and productivity enhancements really across the board, from trading, research, and portfolio execution.
Hey, James, thank you. Appreciate your thoughts. James Camp there of Eagle Asset Management. Finishing up there with AI, looking ahead to that investor conference, that developers conference with NVIDIA, and that speech later on this afternoon. 4 p.m. Eastern time, did you say?
I believe so.
4 p.m.
1% Pacific time. That's where we're at. Happy Monday.
Got it. Oh, early days. He's excited. I'm terrified.
Really?
Honestly, yeah,
Why?
absolutely. I just don't trust the leadership on these issues at all. I really don't. And when you hear CEOs say things like 3-day work week, everything's going to be great, you'll be more productive, it will enhance your job, I just think job losses. That's all I can think of, job losses.
The bigger fear that I have, because there will be either job losses or just increased productivity, and then you don't have to hire as many people to do as much work, right? So that's sort of what he's arguing. James Camp is saying that they're able to do. What I'm concerned about is skilled versus unskilled. How big that gap gets, because you have to have people who can use AI as a tool. And for people who are flexible to adapt to that and be able to then use that to transform the businesses, what about all the workers who can't? Who are not either trained or don't have the skills to be able to use those tools to then get ahead. That, to me, is a pretty significant.
I have a deeper theory, much deeper, and we don't have the time.
Well, yes, we got
that ultimately
30 seconds.
Capitalism will eat itself. The innovation will be so great, the job losses will be so big that we'll be much more dependent on the state. And that will be the end of capitalism as we know it. Even though this isn't really capitalism, but there should be a pursuit of that.
And humanity. It's
yeah, you know, look, I could go on, but it's Monday and I don't want to make you too depressed. Coming up, Monica DeCenso of JP Morgan, Isaac Boltanski, BTIG, Claudia Sam of Sam Consulting.
Inflation has been more stubborn than expected.
Inflation is an insidious thing. That said, we continue to think it's a second half of the year when we see the rate cuts happen.
While the market seems content to price in a June rate cut at this moment, maybe the real departure point for normalization is July or later.
We've been saying for quite some time that the Fed will be slower to lower interest rates.
We are seeing the market really fundamentally reassess the outlook for Fed cuts for this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The first message I received in the commercial break, capitalism will eat itself. Good God, I'm going back to bed. Which I had a feeling that's how people would feel about that. Live from New York City this morning. Good morning, good morning. Massive week ahead. Said that a few times already this week. A recipe for a big week, a dose of NVIDIA, the developers conference kicking off a little bit later this morning, and a sprinkle of central bank decisions. BOJ tomorrow, onto the Fed on Wednesday.
Yeah, I can't really get past this, John. You can't just throw out capitalism will eat itself and then be like, you know, all these really interesting things that are going to be happening.
Power in the hands of the few.
Well, so this, I actually think
becoming more dependent on the state for handouts.
This is the reason why some of these big structural changes do matter. And it raises the question, just to connect back to where you led the show with, which is the Fed and the BOJ and some of these central banking decisions. Are they losing the plot? Are they losing the narrative? Are they losing control over an economic trajectory that is being transformed by other factors, including some of these technological shifts that will lead to perhaps capitalism eating itself?
So we'll strip out AI. Let's talk about the Fed. Is the Federal Reserve losing the plot? Not yet. Has the market? Possibly. Because if you think about how we started the year, it wasn't the Fed that was looking for 3 interest rate cuts this year. It was the market looking for 6 or 7. We've had to take the bulk of that out and do it really quickly in just the space of a couple of months. Is it too early to really change things at the Federal Reserve this week? I think probably. You get a few more months, though, like the months we've seen, January, February, upside surprises, CPI, PPI. Then I think you're going to start to hear a pretty different message coming out of Chairman Powell. Chairman Powell was looking for more confidence about the disinflationary trends of the last 6 months. He was clearly uncomfortable in the news conference at the end of January to say with conviction that the disinflationary trends would continue. A threat to that has been what's happening in goods disinflation. That tailwind has started to pass, and I wonder how concerned they are about that behind the scenes. Whether they talk about that openly and publicly quite so much remains to be seen.
It goes to Mohamed El-Erian's point, which is the concern about not having some larger thesis that's your guiding light. And that when you're so data dependent and the data is noisy and messy and we get so much of it, and it's hard to know which to pick, how do you then get a sense and give the market a sense of forward guidance? When you're basically saying, we don't know, you don't know, who knows? Then how do you get ahead of these things rather than just be subject to the sort of winds that are blowing in different places? This is a big concern. It is fundamentally a policy shift at the world's most important central bank.
The dots don't help them, and I don't think they're going to help them this week either.
I would agree.
Because they're almost constrained by that, held hostage by them. because they've told us to look at them, and then they tell us they're not that important, and then they tell us to look at them. And you have a median dot right now implying 3 cuts. And I say a median dot implies 3 cuts because that's all it really does. That's not the chairman saying 3 cuts this year. Each individual has their own view on that. Ultimately, I think in a base case scenario for them going forward, they do this piece by piece. We might be getting closer to reducing interest rates. In fact, I would go back to Raphael Bostic of the Atlanta Fed. In an ideal world for him, if the conditions are there, he'd cut interest rates and wait, and then talk about the next decision further down the road. We've just been drip-fed sort of aggressive transparency at central banks post-GFC, and we expect them to offer us this roadmap, not just for the next few months, the next 24 months, the next 2 years. We want to know where rates are now, what they're coming down to this year, next year, and ultimately where they think the neutral rate is. I don't think they've got a bloody clue where the neutral rate is.
They don't.
Think about where we are right now. They got rates up to 5.5%, unemployment still south of 4%. Inflation surprising to the upside a little bit, but we have seen disinflation. How much of that was down to them? How can they sit there and say we are sufficiently restrictive? Based on what? Based on what? I don't know.
But precisely, right? So this is the question, right? If they don't have any clue and they're not necessarily going to be able to guide because they don't have a crystal ball and they don't know what the neutral rate actually is, well, then let's say they do that. Let's say they cut once. As we heard from the CEO of Barclays, usually when you start, and then it's a cycle. How do they communicate that? How do they know that? And then when does financial conditions become an issue and a tool for their transmission? If Jay Powell this week comes out and says, I am concerned about how much stocks have rallied, this is absolutely going to move in the opposite direction, will keep us higher for longer, stocks are going to take a hit. They can have influence over that. They just aren't necessarily going to execute that right now.
Can you say bloody on cable?
I think you did great.
Yeah,
I actually thought that was perfect use of bloody.
Sure. Equities right now on the S&P. I think you can. Positive by 0.8% on the S&P 500. In the bond market, 2-year, 10-year, 30-year yields just aggressively higher through last week. A little bit lower this morning, still 4.30 on a 10-year. The euro not doing much, 109 on euro dollar. Coming up this hour, JP Morgan's Monica DeCenso on why she thinks stocks have room to run. BTIG's Isaac Boltanski on Donald Trump's plan for 100% tariffs on Chinese EVs. We'll get into that in a moment. And former Fed economist Claudia Sahm looking ahead to Wednesday's big rate decision. We begin with our top story, the stock market rally hitting pause ahead of this week's Fed decision. JP Morgan's Monica DeCenso saying this: we need to acknowledge the strong start to the year with the S&P 500 now only a few percent away from our year-end 2024 price target. This also argues for more selectivity and being thoughtful if you are still sitting on too much cash. We believe stocks will continue to make new highs. Monica joins us now in New York. Monica, good morning to you.
Morning.
We will make new highs in this equity market. Talk to me about how you put cash to work right now then.
The challenge has been everyone's waiting for certainty. You just talked about that. I don't think we're going to get it. The Fed is never going to tell us what the path is going to look like. And so the challenge becomes, then what do? Do I wait for certainty? Well, anyone who tried that the last couple of years has missed out on a massive rally. And so what we've been advocating to clients is just look at what we can see. Earnings inflecting, right? Put the Mag 7 aside. The other 493 earnings were down last year. We think they'll be up this year. You do have a modest inflationary environment, probably some cuts at some point. That is all good for stocks. Now, I don't think it means another 25% rally, but it is the path to saying maybe 5, 6, 7% from here, which is pretty good after we've already run 7%.
How would you play that? Is that an equal weight S&P 500? Is there a sector preference underpinning that in any way, shape or form?
I mean, the temptation is to say, we'll see the broadening. You've got to go outside of the Magnificent Seven. I think it depends where you're starting from. Many people just don't have enough risk on full stop. So if you don't have enough equities full stop, you should be buying broad. If you are over levered to tech, then that's when I would start looking to things like mid cap, where you have valuations that are significantly lower than the S&P, and you have better earnings growth. And you have leverage to things like industrials.
I was looking at your notes, and it was amazing because there's sort of this clarion call from all different financial advisors saying, get out of your cash. Yeah. Why are you in so much cash? Rotate out. You're going to miss out. But you talk about keeping a buffer. What's the buffer?
It depends on what your goals are, right? Like I work with clients across the wealth spectrum, and so you have to just have a plan. I think that's the biggest challenge. Cash has felt good, but the problem is I've seen balances go 20, 30% plus of a portfolio. I think that's too much, really, whoever you are. And so it comes down to what is my plan? If I'm trying to work towards a 10% buffer, you probably have some wood to chop, most people. I would also argue you look at what the market's giving you. Volatility is still exceptionally low. So if you're really that scared about going into equities and risk assets, I would say dip a toe in and then buy a little protection. You're earning a lot on your cash. Spend a little bit of that to buy some puts or something like that, just to keep you invested.
There is this issue that the winners have won a lot.
Yeah.
The losers really haven't gone anywhere. You start looking at the winners. I think of, for example, Japanese equities.
Yeah.
Do you pile on, or do you sort of say, you know, there's more downside risk here just based on potential surprises from the Bank of Japan and elsewhere?
You know, it's funny. At the beginning of the year, we did see some rotation out of Japan into areas that looked cheap, like China. I get that, just as a tactical trade. But if you are heavily levered to the U.S. from a risk asset standpoint, and Japan has been underinvested in for decades, I think it's okay to say I need to have a little bit of Japan as a longer-term bet. Hard to make a call for 1 to 2 weeks or even a couple months. But I do think there's some reasons to own Japan. Again, very cheap valuations. I think it's like 25% of the TOPIX is under 1x book value, which seems kind of crazy. And then obviously you have policy shifts coming, reforms coming. Again, that doesn't happen overnight, but it's a reason to have some allocation.
We've been trying to work out what happens to Japanese equities if you do get this move in the Japanese yen. Yeah. And certainly things have been pretty contained because we've had 5 days of yen weakness going into this decision. Dollar yen still in and around 150. But just a little bit of scenario analysis. What would happen if we went from 150, 140, 130, 120? Where does that leave equities? Yeah, that is clearly a more challenging backdrop. And I think that's the risk. And so some of our clients have been doing this, trying to hedge out the currency exposure when they've been adding to Japan. That's a little bit more complicated. But again, I think that's why the Japan call can't be a 1 month or 2 month trade. You have to say, I want to have an allocation intermediate to longer term to something outside of the U.S. And I think Japan does look relatively more interesting than, say, Europe right now.
There's this question right now, just taking a step back, whether there's a shift going on under the surface. We saw it last week with commodity stocks outperforming dramatically. Yeah. And it makes me wonder whether we are on the precipice of a reinflating of goods and whether you see that from the increase in activity, not only Japan, but also to some degree on the margins, China and around the rest of the world. Do you lean into that, or do you see that as something that has a sort of self-limiting aspect to it?
We do think, I mean, our outlook for example, Brent, we do think you can see Brent like mid-80s to low 90s. So that does suggest a bit higher from here. That probably is supportive for energy equities. I would remind you, energy equities underperformed last year. That was the one sector that did not do well. And so I think you could see some rebalancing, some addition back there. There's always this struggle, too, with people who want to get on board with the EV revolution, but then you realize we still need oil in the near to intermediate term. And so I think it makes sense to have some allocation there, especially as we figure out what that transition looks like. But I'm not overly worried that we're going to see oil north of 100, barring some big geopolitical shock. And so I think that, from an inflationary standpoint, is a little bit less of a risk.
To wrap it all up, I am wanting to know what your take is on Ben Laidler's point that he made earlier this morning. He kind of kicked off the show with this theme where he thinks that NVIDIA's developer conference, is going to be more important than Jay Powell's speech. Do you think that that's true, especially because in some ways the Fed can't tell us all that much because they don't really have a crystal ball?
I think it's probably true for equities this week. If something cataclysmically negative were to happen today, you would see some rotation out of some of these names that have been so heavily owned. That said, I actually think the tone's probably going to be pretty positive, and you're going to hopefully hear some commentary about how this is not just an NVIDIA story. It's a broad story for the market, for the S&P, for companies that will become more efficient. I know us at JP Morgan, we're using AI everywhere. It's a huge part of all of our conversations and how we can become better advisors, more efficient, quicker, faster. Doesn't mean we're not hiring. It just means hopefully I'll get better at my job and I can do more.
You don't think it ends capitalism?
Not today.
No.
Tomorrow. Longer term, maybe it's a different question, but we'll still be here next week, I think.
Monica, I hope so. It's good to see you. Monica DeCenso of JP Morgan Private Bank. I was looking for the winners and the losers of the S&P 500 year to date. Top of the pile, I'm sure many of you know this, Supermicro Computer up by 276% year to date. Also looking at NVIDIA up 77%. That's number 2. Bottom of the pile, Tesla, Boeing. 2 stocks in a bad place this year.
Boeing because it's one catastrophe after another, and Tesla because there's a real sea change in the idea around electric vehicles. Did you read about the Hertz CEO who left after the disaster? I was reading about the resale value of electric vehicles. It's very minimal, just simply because the battery only exists for 8 years. So if it's only 8 years, and that's the bulk of all of the value in the car, and you have to replace it, you don't get the same kind of resale value as when you've got an engine and you've got all the parts, and et cetera, et cetera. This, to me, is a really significant issue.
No confidence around battery degradation at all, and trying to work out what that secondary market price should actually be. Just on the weekend, can I just say this before we move on? I found the weekend really frustrating. I found it really, really frustrating.
Couldn't tell.
I was thinking back to how the media had covered the former president before, and it always annoyed me. And then they repeated it again this weekend. The comments about there being a possible bloodbath if the former president didn't win this election. I think you always have to mention the context at which those particular comments were made, and then you can make up your own decision. It's not for me to tell you how you should view them. what annoyed me about the weekend was not only the absence of any mention about the auto industry, but the failure to respond to the policy that was actually being mentioned in that address by the President of the United States, the former president, talking about a 100% tariff on automakers out of China in Mexico. So you've got to start thinking about the potential for that policy to become real and not just staying there, but maybe spreading. And once again, over the weekend, just totally failing to focus on the policy and just to go with the sentiment and the clickbait of the headline. And it just gave me a sense that we're going to repeat the same mistakes we made last time around covering this president.
I want to stand up and clap. I think I should. You know how I feel. I completely agree with you. The policy, let's talk about that. Why are we focusing on the noise and the theater of it? Let's move on. I think you're absolutely right.
I know there's a home bias, but I have to say, you know, just to endorse the team here at Bloomberg, the headline was the potential 100% tariff, and then the other stuff, bloodbath, is mentioned in the body of the story. I mean, that's how you should do it. But hey, equities right now on the S&P 500 up by 0.8%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Biden is preparing the toughest ever pollution limits on American cars to accelerate EV sales. Speaking of, the EPA will finalize the limits in the coming days. The idea is that it will help the U.S. meet the Paris Climate Agreement commitments. It is a political balancing act, though. Biden is trying to court voters in the swing state of Michigan, including auto workers who are often uneasy about the quick transition to EV. Apple is in talks to build Google's Gemini AI engine into the iPhone. Sources say the two companies are in active negotiations to let Apple license Gemini to power new iPhone features this year. For years, Google has paid Apple billions of dollars to let it be the default search engine on its Safari web browser. The cocoa rally shows no signs of slowing. It's doubled in less than 3 months and is now trading at a record high. West African crops have been battered by diseases and extreme weather. The rally accelerated just ahead of Easter, where a lot of people buy chocolate and chocolate eggs in many countries. Now the price surge is starting to bite at the grocery store. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, Trump doubling down on Chinese tariffs.
We're going to put a 100% tariff on every single car that comes across the line, and you're not going to be able to sell those cars if I get elected. Now, if I don't get elected, it's going to be a bloodbath for the whole. That's going to be the least of it.
That conversation up next, live from New York City this morning. Good morning.
The Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data.
We're still seeing sticky inflation. How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Just you and me this week, flying solo. TK took the week off.
Yep.
He's gone on vacation.
Yeah, I got a message from him.
AMH is threatening to take the whole week off.
They're all on vacation. They're all leaving us.
Yeah, skipping the Fed meeting, apparently. Equity futures on the S&P positive by 0.8%. Session highs this morning, this Monday morning, to kick off a trading week. Equities pushing higher after some very mild losses last week, down about 0.1%. In the bond market, yields just about unchanged, 430.63 on a 10-year. Under surveillance this morning, Trump doubling down on Chinese tariffs.
If you're listening, President Xi, and you and I are friends, but he understands the way I deal, we're going to put a 100% tariff on every single car that comes across the line, and you're not going to be able to sell those cars if I get elected. Now, if I don't get elected, it's going to be a bloodbath for the whole. That's going to be the least of it. It's going to be a bloodbath for the country. That'll be the least of it.
Here's the latest this morning. The Republican nominee threatening to slap a 100% tariff on Mexican-made Chinese EVs if he wins in November. Joining us now is Isaac Boltanski, Director of Policy Research at BTIG. Isaac, before we even get into how this would work in practice, can we talk about how this is playing in Detroit, Michigan? How is this playing?
Yeah. Look, I think that we need to understand that this is a very, very long general election. It's going to be the longest general election ever. And we still have 231 days of this left ahead of us. And I think that we need to understand why the former president was saying what he said and where he said it. This was to play in Ohio and Michigan. And I can tell you, going through the local papers in Michigan and Ohio, which is something we try to do to try to understand how these swing states are looking at developments on the campaign trail, it's playing pretty well in Michigan today. And I think that one of the things you're going to see, John, over the next few months is you're going to see both of these candidates trying to go after union workers. So look, this Trump commentary on 100% tariff on EVs, this is something that is meant to play to the manufacturing base in Michigan and Ohio. It's the same reason that you've seen President Biden change his tone and become more aggressive on the U.S. steel deal. These are all politically motivated dynamics, but each of them have real market implications.
It looks like they're going to go at things slightly differently, though, Isaac. At the moment, the administration is looking at the supposed national security threat of Chinese EVs. The president's coming straight out and just saying, the former president, we're going to put a 100% tariff on them, even if they're made at the border in Mexico. Isaac, can you tell me how that would work in practice? Can they basically discriminate against one manufacturer from one country in Mexico?
So look, there are always hurdles here, right? And we need to understand that there is a chasm between rhetoric from the campaign trail and the reality of implementing policy. But ultimately, when we cut through the noise, I caution clients that doing anything takes a while. You've got to expect that you'd have 6 to 9 months of back and forth before anything tangible came into place. But the simple answer is yes, the president has wide authority on his tariff powers to implement tariffs that would accomplish this goal in practice. Of course, you can't do this where you have a singular pushback on the tariff side. You would have to create a broader framing and broadest lattice work, but all of that can be done. And so we have to take seriously these threats under his 301 power in particular, where he can do many of the things that he's implemented, even though it's going to take a little bit of time from when and if he actually gets behind the Resolute desk again.
John, wasn't it Lori Calvasino who said that basically it's like staring at the sun?
Yep.
That essentially, you've mentioned this before, that this election cycle is like staring at the sun. It's obviously massive. It has significant implications, and it's blinding in your ability to actually respond to it. How seriously are your clients, Isaac, taking concepts like this, the idea of a 100% tariff that's being thrown out there by someone who could potentially get the power to do that?
It's a little bit concerning. I got to tell you, there is still some disbelief that it's going to be Biden v. Trump to begin with among my clients. And then there is a almost outright dismissal of the tariff side. I think that a vast majority of clients are focusing on what Trump would mean from a deregulatory perspective, for energy, for financial services, for healthcare, and they are just pushing aside the risk of the tariffs. And I think this is in part because of what we saw last time. If you recall, the first 2 years of the Trump administration was focused on tax cuts. It was all of the good for the market, right? And then we began focusing on tariffs. This time will be different. Tariffs will be a day one focus. And that's something that I'm trying to push across in terms of understanding what will happen if Trump is, in fact, the winner of this election. I think the market's got to start to come to terms with what that means, not just for geopolitically, but for supply chains and for the Federal Reserve.
Isaac, one thing that Ken Rogoff of Harvard said in a recent interview on Bloomberg TV was that both Trump and Biden were incredibly protectionist presidents, some of the most ever. Has that been accurately priced into markets, putting aside who wins, the fact that both of them are likely to have pretty protectionist policies?
So I think the simple answer to that is I don't think the market is prepared for each one of these candidates to try to out-China hawk the other, right? Again, we have 230 plus days of this to go, and we're going to have a fair amount of China bashing in particular. And so I don't think that the market's prepared for that. I don't think that the market is prepared for what's incredibly important here, which is former President Trump going after the onshoring and nearshoring even themes that we've seen over the past few years. So it's not just China bashing. He's going after Mexico. This could also lead to cooler relations with Taiwan, cooler relations with Canada. There are myriad implications there that I think the market's looking past, in part because they're not sure that it's still going to be Biden v. Trump. And then they think that Trump is just talking on the campaign trail to get votes and would immediately dismiss these policy goals when he's in the White House because of their inflationary and economic impact. I'm not sold on that.
So well said. Isaac, wonderful to catch up with you, sir. Isaac Boltanski there of BTIG, Content and Sequencing. If you go back to the first term of the former president, the sequencing, and Isaac was talking about this, and we've covered this before, the focus was on tax cuts. Then later on in the term, the back half, the focus was on the trade war. To Isaac's point, the focus this time around is going to be on tariffs almost from day one, based on how the campaign is going.
And he's saying it's not being priced in or taken seriously at all because people are saying it's just campaign rhetoric. And are these even going to be the candidates that we have? Because people are still doubting that.
And that's still where the conversation is. Just struggling to move on from that. These are the candidates that we have in front of us right now.
Yes.
Coming up next, Claudia Sahm of Sahm Consulting on the Federal Reserve. The brilliant Claudia, just around the corner. This is quite a start to the trading week. Equities all-time highs, possibly again. We're positive by 0.8% on the S&P 500. The Nasdaq 100 up by 1.2%, taking back some of the losses of the last couple of weeks. And I have to say we can do that in a single session because we were only down by 0.1% last week and something like 0.25%, Lisa, the week before.
That's what I was going to say. Is this a dip that's viable? I mean, does that even count as a dip? We're down less than 1% over 2 weeks. It's the biggest weekly fall of the year. And still, this is something that's viable because why not?
Rallying again. Equities up and away in the face of a real repricing in the bond market. 2-year back in the 470s. Further out along the curve, a 10-year back in the 430s. Both of those maturities, those yields higher last week by more than 20 basis points. Lisa, off the back of hotter than expected CPI data, backed up by an upside surprise on PPI.
What I find interesting is that nobody's talking about retail sales. And to the extent that they are, they're talking about them as not being that bad. That's what we heard from Lindsay Piegza. And at the same time, when do we start seeing this narrative shift on the margins away from yields are just rising for the right reasons, which is growth? At what point does it become yields are rising because inflation is still too sticky, even as growth decelerates? Somehow that part of the narrative has gotten thrown out.
If you were worried about a really big reacceleration of a super hot economy, retail sales didn't speak to that, did they? 2 months of it, not just a single month, but two.
Which is, and you're not just seeing it in that retail sales number, but also in some of the credit card data that you're seeing anecdotally out of some of the banks. It's not conclusive. This has been a very maddening cycle for anyone who wants definitive trades or definitive convictions, because this isn't a time you're going to get them, right? I mean, that's essentially where we are, and the Fed's probably going to reflect that on Wednesday.
Can you find it in foreign exchange? Dollar yen, 149.
Oh, yeah. Wow.
Dollar yen. What did Kit Jukes' stock trend say? Someone tell the Japanese yen that it's a historic meeting tomorrow. 149 on dollar yen. We've basically seen yen weakness, some mild yen weakness over the last 5 sessions. So that's the longest streak of the year so far. Still basically in and around 150, at least going into potentially the first interest rate hike in 17 years.
Yeah, you can feel Kit Jukes' frustration and the frustration of all FX strategists basically saying, wake up, do something. This is going to be a massive move, and yet nothing. Look, all of these moves are coming after great expectations for so long that people have baked it in. I'm struck by how much that we're seeing stasis in the euro versus the dollar. These are going to be long-term shifts, but right now, is anything changing relative to expectations at all?
Right now, in FX at least, not much. 149 on dollar yen. Under surveillance this morning, Israeli Prime Minister Benjamin Netanyahu firing back at Senator Chuck Schumer.
What he said is totally inappropriate. It's inappropriate for to go to a sister democracy and try to replace the elected leadership there. That's something that the Israeli public does on its own, and we're not a banana republic.
Netanyahu's comments coming after Schumer called for elections to remove the current Israeli government. Schumer labelling Netanyahu a, quote, obstacle to peace as concern grows about the civilian toll of Israel's war on Hamas in Gaza. Netanyahu saying that another ground offensive in Rafah is the only way to eliminate remaining Hamas brigades. That, as we know, and Lisa, we've framed this a few times, is a red line for the President of the United States. What remains unclear as to what happens if indeed Netanyahu is hell-bent on crossing it.
And what's also unclear is how much of some of this rhetoric really is coming as a plea to certain constituents in the Democratic Party to say, we know, we're on it, we want to ratchet this back. We want to distance ourselves from this conflict to some degree. To me, that's going to be one of the hardest parts over the next couple of weeks. How much do you distance policy from politics when it comes to some of the rhetoric coming out, frankly, from Schumer, from Biden, and then what we were just hearing with Biden with respect to the former President Trump and what he had to say about tariffs?
Because the rhetoric has shifted big time, that's for sure. Let's turn to our next story. Apple and Alphabet considering a deal that would allow Google's Gemini AI to power new iPhone features. Sources telling Bloomberg the tech giants are actively negotiating a plan to let Apple license Gemini AI models for new iOS capabilities as soon as this year. The deal would build on Apple and Google's years-long partnership over Safari's default search engine. It would also give Gemini AI billions of potential users. But the potentially blockbuster AI deal also threatens to draw more antitrust scrutiny. So we started the programme with this story, Lisa, and we talked about the three dimensions to this. One is antitrust, clearly. Two is how much Apple is apparently behind in this effort, given that they need a partnership with Google to do something about going forward from here. And three, the potential, and this is the Dan Ives of Wedbush dream, that you adopt some of this technology, these advancements, as early as September, put it in a new phone. And for those of us, me, others, who have been sitting on the sidelines waiting for a new smartphone that's actually worth upgrading to, this could be the year.
So just to pick apart some of those things, the middle one in particular, that they're late, that they're not as far along as people previously thought. They just shifted their staff that had been devoted to the Apple Car to the AI initiative. Is there a race to get to that September finish line in tandem with Samsung? We know Samsung will probably unveil something around that same time with artificial intelligence, using technology from Qualcomm and a bunch of others. Is there some sort of imperative to have that kind of timeline and not have the Apple luxury of waiting and then just doing it better? To me, that's the signal here that's really significant.
Yeah, but what's the risk that others go to Samsung, or that we just don't upgrade at all if they don't do that?
You know,
both.
I would argue both, because if there really is transformative technology that somehow makes it a different experience, then why wouldn't people go to the Samsung, right? Why wouldn't they gain market share in a way that Apple kind of can't afford to at a time where the iPhone still is the bread and butter of the entire organization?
Because the ecosystem's so sticky and you can't get away from it. It would be such a pain. Can you imagine the pain of switching at this point to something else?
I have family members who are very against the sort of forced ecosystem that you have to participate in, and so then they bow out and they go to Samsung, and then all of their texts are so annoying because you can't sort of like them, and when they like them, then you get a separate message. It's so irritating.
The regulator feels the same way. All eyes on this week's Fed rate decision. The FOMC widely expected to hold rates steady Wednesday and make their first cut potentially in June. Investors will be focusing on the so-called dot plot and an updated summary of economic projections. Fed Chair Jay Powell telling Congress earlier this month that the central bank is, quote, not far from an initial cut as it looks for just a bit more evidence inflation is moving towards 2%. Former Fed economist Claudia Sahm, and good friend of this programme over the years, joins us now for more. Claudia, wonderful to catch up with you. As you've said, maybe a challenge for Chairman Powell this week is to make sure that everyone stays around the 3 implied in the median dot. Can we just start with the dots themselves? Because I know you have thoughts on this. When can we and how can we get away from this?
It's hopeless at this point. I mean, everyone wants some scrap of certainty, and they look at the Fed and have a very misguided belief that the Fed is going to give that to us. The Fed would really like a scrap of certainty about what they're going to do later this year. My hope for this meeting, it is the most boring meeting ever, and you have traders falling asleep at their desk. Like, we know they're not going to cut this week, and we better not see anything material change on that summary of economic projections. In particular, are we looking at likely 3 cuts or 2 cuts? Jay is absolutely, my reading of what he has said, he is a let's cut in June. He's got to keep it together. If those dots move towards July, which I actually think that's not likely, or the longer run estimate of where the rate should be, the infamous R star, either of those two could get people antsy and push the expectations to July in the markets.
I am a long-standing hater of the dot plot. I love the way you write. Thank you for that. Claudia, I am curious whether you think it's a liability, though, that the Federal Reserve isn't operating with some sort of overarching thesis of where the economy is right now post-pandemic, about whether it is sort of a hotter and higher inflation regime, or if it is going to revert back to something more of what we were accustomed to pre-pandemic.
My expectations of what the Fed is on track to do did not change last week. We had the second disappointing read on inflation. We also had the second disappointing read on retail sales. And Powell has talked about multiple times that the risk to the two sides of the mandate, the stable prices and the maximum employment, those risks are coming into balance. And we saw that last week, right? That nailed the balance of, yeah, inflation has been not so good. And really January, clearly from the February, looks pretty fluky with owners equivalent rent coming back down. And those retail sales, those are not good numbers. I mean, I did consumer spending at the Fed. Those are not good numbers. So that should maintain the quote unquote coming into balance.
Well, can you elaborate a little bit on why those are not good numbers and why that's important? Because we were hearing earlier this morning from Lindsay Piegza that they weren't that bad and that you're seeing a deceleration, but overall, there still is quite a bit of spending, and you can tell that balance sheets aren't terrible. Why are they terrible?
So in terms of the retail sales, I mean, these were declines, right? Like, these aren't good numbers. And yes, a deceleration was what we were looking for, but we know, and the flip side is the acceleration worries on inflation. We know once things get going, it's kind of like the snowball, right? This is a big economy. It takes some work to get it going. And then you can end up with like a really big snowball that's like crushing us and bringing down the economy. So once you start going in a direction, there is a danger that you build up speed in that direction. For the economy, for the spending side, that would be a contraction in spending. That's a recession if we get there. And on the inflation side, if that not just sticks, but kind of gets, going, that's a big problem too, right? So they have the potential for two big problems, which speaks to don't do anything, just let us see.
Claudia, I'd love your thoughts just to wrap things up on inflation as well. We had a hot CPI print relative to expectations, likewise on PPI. Were there components of that gave you encouragement, maybe even made you uncomfortable about the path ahead? What were you focused on?
Well, first, the encouragement. We did see the owner's equivalent rent, which had come in really hot and inexplicable in January. That did cool back off. So that tells us a lot that piece, which was very important in CPI and important in PCE, that was something fluky in all likelihood. Now, the discouraging part is what we've gotten into in the core services outside of shelter, the super core. The stickiest part in there is motor vehicle insurance. And the homeowner's insurance is in there too. That is not about the Fed. The motor vehicle, that is a knock-on effect of the used car prices. The car prices were high. They're making up for repair costs. There's really not relief on the horizon for that piece until later in the year. That's an unfortunate part of inflation for us to latch onto, the Fed to wait on. And yet it's in there. I mean, it is making a contribution, and it is outsized from before the pandemic, and it ain't going away probably for a little while.
You know the inner workings of the Federal Reserve better than most, Claudia. How do you think they would deal with that around the table this week? And how do you think Chairman Powell will address the topic in the news conference?
My goal in the news conference to get markets to kind of stay where they are. And we're at this rare moment that the Fed is kind of lined up with markets, this June cut and probably where Jay Powell is. So I think it's reinforcing you have a balance of risk. If we don't see retail sales mentioned in the statement, then that's a sign they have gotten more hawkish. There are all these details under the hood, like motor vehicle insurance. Yeah, that's wonky. And yet it gives hawks. I mean, if you look at the top line, it gives them cover to push out to July. Frankly, I think they're going to win. July is my baseline. And so it's the messaging, but the Fed knows better. Like, they know what's under the hood. It's just a question of, can they look past it, or are they going to get antsy like sometimes they do?
Interesting. Claudia, you're one of the very best, and we always appreciate your time. Thanks for being with us. Claudia Sahm there of Sahm Consulting on the Federal Reserve. The inner workings of the Fed, how they'd look at that data, Lisa, from last week, because it's not how you and I want them to look at it. It's how they actually look at it that matters.
And it actually matters, all the line items and exactly what the comps are actually showing and how much this is sticky inflation or not. I sense frustration from everybody this morning. I feel like it's a very frustrated morning. Is it just me?
Is it still Q1?
Yeah, well, it's just sort
How long does the first quarter feel at this point?
Exactly. I mean,
right?
It's sort of, I get the sense people want some certainty. They're not getting it, and they're really frustrated.
I was thinking this yesterday evening. I was getting together everything for this programme, going through the notes, looking at markets. I was just thinking, I can't believe it's still Q1.
I know, it's been ridiculous.
Seriously.
Yeah, I think a lot of people...
Feels like we're sort of like deep into the second quarter already. I mean, to your point on the election, it's 8 months away. It's 8 months away.
Right. So how are we going to actually evolve this, considering it's going to be literally the same story, which is, yes, they are still the candidates. Yes, they are running. And we're going to have to figure out what that means.
Andrew Hoddenhorst, The City, just published, so I'll share some of that with you if you'd like. If you don't, I can't hear you. So despite stronger core inflation, I hope you'd like this. We do not expect a significantly hawkish FOMC meeting on Wednesday. In our base case, median dots stay put, indicating 75 basis points of cuts this year. But even if we're wrong and the 24 median dot shifts to imply just 50 basis points, Powell is likely to dovishly emphasize that the Fed is on track to cut rates this year due to sub 3% year-on-year core PCE inflation, even if activity holds up. So that's the view. There is just a view that even though the data's changed somewhat, that Chairman Powell hasn't.
They want to cut. And that's the reason why I think a lot of people have enthusiasm around equities, because if the bottom line is they want to move, and as Claudia Sam said, maybe they get antsy and they do something even if the data doesn't really back it up.
That decision coming up on Wednesday. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The NASDAQ stock market says it has resolved connectivity issues this morning. Pre-market trading on the exchange was disrupted for more than 2 hours. In a statement, NASDAQ says it determined the root cause, but it didn't go into further detail. Bloomberg data shows no trades printed on the NASDAQ global market starting at 4:09 a.m. New York time. The exchange says that any unacknowledged orders on its Rash Fix system have been canceled and put back to customers. Barclays is looking to expand relationships with sovereign wealth funds and private equity. Barclays CEO C.S. Venkatakrishnan offered more detail earlier in the program this morning.
I think it's an important part of the shift that's happening. And it's happening because previously in the investment banking side, we were working with corporations. And since then, we still work with corporations in a very big way. But in addition to that, you've got the financial sponsors and the sovereign wealth funds. So the growth of concentrated pools of capital makes it important to have that full relationship with those players in the market.
Last month, Barclays announced a $2.5 billion cost-cutting drive and a reorg to boost profits. The March Madness games are set. Millions of fans are now going to try their hand at correctly predicting 67 college basketball games for the elusive perfect bracket. Good luck if so. Defending champions UConn are one of the year's top seeds alongside Purdue, Houston, and North Carolina. No fan has ever completed a perfect March Madness bracket. The NCAA says the odds of doing so equate to about 1 in 9 quintillion. That's your Bloomberg Brief. John.
We will do what we always do on this program. Manager is a Purdue grad. Boiler up.
Yeah,
every single year.
Yeah, is that what you do?
Yeah, every year.
Yay. We're going to have lots of like
trying to make that mid-year reval go just a little bit better.
Is that so?
Yeah.
Is that what's going to do it?
Boiler up. Up next, all eyes on NVIDIA.
When you look at the godfather of AI, Jensen and NVIDIA, and we'll see it on Monday, right now it's their world, everyone else is paying rent. To flex the muscles of for Jensen, wearing his black leather jacket.
I love how Dan talks about this. It's like a wizard putting on a cloak. Leather jacket goes on.
Yeah.
Talk up the stock, another $200 billion.
The godfather of all AI.
Just like that. That conversation up next. This is Bloomberg. Live from New York City, Fed decision just around the corner. That takes place on Wednesday. Two-day meeting starts tomorrow following a BOJ decision, which may include the first interest rate hike since 2007. Bramo, drumming things up.
Oh, yeah, it's going to be so exciting.
It's just not happening, is it?
Check out that currency pair.
I mean,
wow.
I say it's not happening. I'm not saying the interest rate hike's not happening. I'm just saying, like, the price action's not happening going into it. Dollar yen is almost totally unchanged at 149. Elsewhere, we have some price action if we can turn towards the board. Equity futures are up by 0.75%. Spoil over here. That's a nice rally. Takes back some of the losses of last week and some. Yields are higher again by 2 basis points. We're staring down the barrel of the highest yields of the year so far. Very close. Lisa, 432.42.
Which comes because we are seeing hotter than expected inflation, and the big surprise of the year has been the resilience, both with respect to the economy as well as earnings. You put both of those together, it raises this question: how are rates going to go down all that much in the near term?
Yeah, this week is not just about central bank decisions. It is also about this. Under surveillance this morning, all eyes on NVIDIA.
When you look at the godfather of AI, Jensen and NVIDIA, and we'll see it on Monday, right now it's their world, everyone else is paying rent. This is a grand entrance, and it's also a showcase. It's to flex the muscles. Look, we believe it's a 1995 moment. This AI revolution.
Here's the latest. NVIDIA's annual AI conference kicking off with sky-high expectations. Analysts and investors calling it AI Woodstock as they wait for new product announcements and more that could solidify NVIDIA's leading position among AI players. Meanwhile, Apple is playing catch-up. Sources telling Bloomberg that Apple is in talks to build Google's Gemini AI engine into the iPhone. Bloomberg's Alex Webb joins us now for more. So, Alex, two separate stories. Let's start with the NVIDIA conference, and then we can turn to Apple. What are you expecting from Jensen a little bit later today?
We're expecting to see what the next generation of chips looks like and what they can do. The B100, which people know is coming, but the nature of the innovations in it will essentially determine how optimistic the investors are about it meeting these incredibly ambitious targets that analysts are setting for it. It is clearly trading at a hefty old premium, but hefty old numbers. It's 35 times its forward earnings at the moment. That's not massively out of kilter with names like Microsoft. It still trades actually at a bit of a discount to AMD. That's partly because AMD's earnings haven't yet been, the estimates haven't gone up to meet the expectations where the stock is at. So the thing will be fascinating to see how similar this thing is to, say, an Apple event. I mean from a trading perspective, because quite often what you see with an Apple event is a bit of profit taking. The adage is you buy the rumor and you sell the news. Well, there's been a little bit of a sell-off in NVIDIA over the past few days. Sometimes good news actually doesn't deliver the pop in the shares that you might expect, because people think, oh, well, actually, it may not get much better than this right now. And so you see a bit of a sell-off. So it'll be fascinating on many different levels.
That's a strong point. So, Alex, let's talk about an Apple event. The reporting from the team here at Bloomberg, fantastic reporting that Apple is in talks to build Google's Gemini AI engine into the iPhone. We had some commentary from our good friend Dan Ives at Wedbush this morning, calling it a major win for Google to get into the Apple ecosystem. Alex, I want to understand from your perspective, in your opinion, what this says about Apple and where they are in this race.
So it's interesting because I floated this idea to someone just, as a possible column idea. Maybe we should write that Apple should actually open up Siri to one of these other AI engines, and the response I got from a colleague was like, Apple would never do that. And of course, this looks to be what they're doing, and it shows actually two things. Firstly, of course, that Apple perhaps isn't as close to having its own competitor to Gemini, to GPT-4 as it would like, but also how significant, how important it sees this as a competitive differentiator. If you're going to have phones over the next 1, 2, 3 years where you can properly engage with an AI engine conversationally, that might be a significant differentiator when it comes to people deciding what handset they're going to buy. So Apple, clearly is a defensive move to ensure that they have this tech in their devices, and they are handing over what could be a very significant part of that proposition to what is, frankly, in mobile operating systems, a meaningful competitor in the form of Google.
Alex, how can they get around the idea that a lot of regulators are not going to like the fact that two of the biggest companies in the world are teaming up to be even bigger?
Well, the thing is, it's slightly different from the search thing, right? Because, of course, what was happening with search is it was pushing people into Google's ecosystem and therefore giving Google the opportunity to serve ads on that basis. We don't fully know actually how this is going to push people towards a similar thing. The way that AI is being monetized is still kind of being worked out. It's very much a cloud product at the moment. The people providing these systems are making money from selling the cloud services. So it's a slightly different case from Google being the default search engine in iOS. Doesn't mean, of course, that the regulators won't look at it, but it isn't. You'll excuse the pun, apples for apples.
Alex, I want to finish on Google because they've had a difficult time, and I did get the pun. We'll let that go. I want to talk about Gemini. Alex, it hasn't been a good start for Google unveiling and rolling this out. And I guess my question would be, I get that Apple's behind, but is this something they want to go near at this point?
I think, look, the concerns with Gemini were very much about this image generation piece, and that was the colossal flub, which, of course, they've admitted to and said that they need to fix. They recognized that it was a mistake. At this stage, it looks like, and we don't fully know, and don't forget, this deal with Google is not signed. Mark Gurman, our colleague, also reported there were talks with OpenAI. But it seems more to be on the language front, right? To be able to engage with it, ask questions, perhaps, search the web as well. The image piece is entirely separate. There's also a little bit of time until this will come into a product. If they reveal such a deal at WWDC, which would be in June, it wouldn't actually hit the operating system until September time, most likely.
Yeah.
That gives Google plenty of time to fix these problems.
Alex, thank you, sir. Alex Webb there of Bloomberg, looking ahead to the NVIDIA Developers Conference a little bit later today and talking about that potential partnership between Apple and Alphabet. Alphabet in the pre-market celebrating that win, if that is one, up by something like 5%. Here's a win for us. Surveillance on tour tomorrow. Fantastic lineup. We'll be taking the show live to the Bank of America trading floor. Here's the lineup for you. The CEO, Brian Moynihan, Mark Cabana, the head of US rate strategy. We'll catch up with Savita Subramaniam, the head of US equity strategy, Mike Gapin, the head of economics, and a whole lot more across 3 hours of programming, Bramo, starting 6 Eastern tomorrow morning.
I'm so looking forward to it, especially given the fact that we are heading into such a massive week, and to get sort of a bird's eye view on the different components of an economy very much in flux will be terrific.
That'll get the week started in a big fashion, going into those big central bank decisions later on this week. Live from New York City this morning. Good morning. This was Bloomberg Surveillance.